welcome you all to this joint conference organized by the NBER, FLAR, and the Central Bank of Peru here in this historical city of Lima. In these 2 days, we were going to discuss about very relevant issues for emerging market economies, capital flows, debt overhang, inflation, and growth. First, I would like to extend my deepest gratitude to the NBER and FLAR for making this conference possible and putting together this impressive program. Emerging markets have been facing significant challenge. Inflation has been declining in the region and globally, but at a different pace. Central banks feel that the job is not yet completely done. And this has also implied that monetary policy is going to different speeds around the world, creating a lot of capital flow volatilities. We have observed this during the first quarter during this year. Also, economic growth has slowed down in the region, in Peru as well. And so that has put some additional challenge for those countries that have to follow fiscal consolidation. So the topics we're going to discuss today, capital flows, growth, inflation, are very relevant for central banks and for emerging market economies. So I'm sure we're going to learn a lot during these two days. I really would like to thank you for being here, for sharing with us your research, your insights. I'm looking forward to the discussion. I hope you enjoy the city and the hospitality of the Central Bank of Peru. Welcome to Lima.
Thank you so much, Paul. And now I will give the floor to our Executive President, Jose Uribe.
Thank you, Carlos. Thank you, Paul. Good morning, everyone. I think that Paul said everything I have to say, and so I will be very, very brief to welcome you to this spring seminar. And in this case, in this time, the NBER, the Central Reserve Bank of Peru, and FLAR have collaborated to facilitate this high-level academic discussion on topics critical for macroeconomic and financial stability. I extend gratitude to the Central Reserve Bank of Peru for their warm hospitality and invaluable partnership in this endeavor. Additionally, a special thanks to the NBER team for their trust and collaborative efforts. It is a pleasure to continue joining efforts in the future. The themes of our seminar is not only of great relevance, but also timely, given the current global and regional circumstances for several reasons. I think Paul said the reasons, but let's repeat here something. Nations are grappling with the economic repercussions of the pandemic, including increased debt levels amid prolonged high interest rates. Although inflation has been on decline since 2023, following the inflationary shock of the preceding years, we must remain vigilant. Inflation has yet to meet the target in many economies, and several factors could still exert upward pressure. And third, the persistently high interest rate set by major central banks, especially the U.S. Federal Reserve, may complicate decision-making for the economic authority of emerging and developing economies. The recent years have provided abundant material to explore the dynamic interplay between price stability, financial stability, and fiscal sustainability. This seminar offers a platform to discuss 11 insightful papers over the next 2 days, culminating in a roundtable on economic policy. These discussions are poised to enhance our understanding of recent economic trends, challenges, and these implications for public policy. This seminar is a forum for advancing scholarly discussion and forging new pathways in economic theory and policy. Thank you very much.
Thank you, Executive President. I reiterate our thanks to all of you. It will be a very great seminar. So, Cristina, the floor is yours. Thank you.
Thank you. Thank you very much. So we're going to get started. Our first presenter is Lorena Keller, Just a little bit rules of the game. So each presenter is going to have 40 minutes. Then the discussant is going to have 10 minutes. And then we're going to have 10 minutes for quick response and some questions. We do encourage clarifying questions. So, ask your question directly to the presenter or to the presenter during their intervention. Lorena, please.
Now? Yes. Okay. Well, thank you so much for including the paper in the program. I'm delighted to be here and presenting this work. So the paper that I'm going to be presenting has to do with arbitraging covered interest rate parity and bank lending. So just to give you a little bit of a sense of what this paper is about, is that recently, particularly, well, after the financial crisis, there have been, in many developed countries, it has been seen that there's an arbitrage opportunity in the exchange rate markets, that is the covered interest rate parity is not holding. And since then, there have been many studies trying to understand why doesn't it hold and what does that imply for other asset prices. In this paper, I take a little bit of a different perspective. And what I try to do is to see whether there could be a potential channel through which these arbitrage opportunities not only affect, different prices and maybe understanding why they exist, which I think is pretty valuable. But in this paper, I try to see whether there are potential channels through which it can affect the real economy. And a little bit of a preview is that a way in which it can affect the economy is, I'm looking here, by the way, in a partially dollarized economy. And in these economies, what happens is that when there are these arbitrage opportunities, banks might want to arbitrage them. When that happens, they need funding in one particular currency. So the funding in that currency becomes more expensive because banks need this funding. And what they do in their lending market, or what is this reflected in equilibrium, is that then firms and households are going to borrow in the cheapest currency, which is not the one that banks are using. So in that sense, it can affect the allocation of exchange rate risk for firms, depending on which currency they want to borrow. Right? So this is the paper in a nutshell. So let me just give you, now go a little bit deeper into this. So the covered interest rate parity is the fundamental pricing equation, equation for forwards and swaps. Basically, what it tells you is that the return of lending in one currency has to be equal to the return of lending in another currency after you hedge any exchange rate risk. But however, like starting in developed countries, starting with this very good paper from Du, Tepper, and Verdehan, it has been documented that there are these large CIP deviations that occur in developed countries even after the financial crisis. So they are not really an aspect of just a crisis period. And here in this paper, even though this paper is looking, and more of the literature has developed in terms of the developed countries, in this country I show that these CIP deviations or covered interest rate parity deviations exist also in emerging markets. They existed even before the crisis. So here we have, I am plotting these deviations, which are just arbitrage opportunities for various countries in Latin America, which is Peru, and then I have some average on Chile and Mexico and Brazil. So, here, just wanted to show you that they exist. They could be potentially large. And now I want to explore how can these covered interest rate parity deviations affect bank lending in a partially dollarized economy. And what does that mean in a partially dollarized economy? It means that banks are borrowing in both foreign currency, so you can think about it dollars, and in the local currency. And they borrow in these two. They have deposits from households and firms in these currencies. And then they lend also in these two currencies, in the foreign one and in the local one. So how can these CIP deviations affect bank lending in such a partially dollarized economy? I propose a channel, which is that when there are these arbitrage opportunities, banks may want to try to arbitrage them. You can also think about market making. I mean, they're equivalent. They have the same result. But they are trying to arbitrage. And when they do so, they are going to try to borrow in one particular currency. Imagine that currency is scarce at the time that banks need to fund that currency, right? If there was no constraint, just fund any amount they want and nothing should be affected. But if there's some scarcity of the they need to borrow, what is going to happen is that then, because banks are going to arbitrage them, but at the same time they're going to borrow more in that currency that is scarce, at the end, where it's going to end up affecting the exchange rate composition of their bank lending. They're going to start lending more in the currency that they don't need, right? And less in the currency that they need to borrow to do the arbitrage. So I propose this channel, and then I try to test it. I test it in 3 steps. In the first step, I just show that the bank's transactions are consistent with them arbitraging these deviations, right? So the deviations require banks to do many set of transactions at the same time, and I show that they do. It's just a correlation, but I show that this happens at the same time. In the second step, I show that the currency required to do the arbitrage is actually particularly scarce at the time they need to do this. So given these two, and these are just correlations, there are nothing on the causality here, but given these two, what I try to do is I try to exploit heterogeneity at the bank level in terms of how much each bank can arbitrage or how much they arbitrage, to show that the banks that arbitrage more, they end up lending, so they need to borrow in one particular currency, so they end up lending less in that currency, and they substitute it for the one that they don't need, right? And in order to try to have a little bit more on the causality part, what I do is I exploit that banks are heterogeneous in terms of how much they arbitrage, and they're going to change their lending to control for any credit demand. They're going to change. I'm going to see how two banks that arbitrage differently, how they change their lending to the same firm on the same month based on their arbitrage. And I show that this is consistent. And I find that banks that allocate, for example, 1 percentage point more of their assets to do the arbitrage, they end up substituting around 20% of the scarce lending, a scarce currency for the one that is not scarce. Right, so this is just an overview. So just let me go just do a review of covered interest parity, and then we can then use those results to dig deeper into each one of these. So the covered interest rate parity, as I was saying before, is just a fundamental pricing equation for forwards and exchange rate swaps. And what it means is that an investor, and in here, by the way, I am going to be talking, I have data on Peru, so this the whole setting is going to be in Peru. So right now I'm just thinking about a bank in Peru who has to be, for example, indifferent between two different strategies, right? So the first one is just to lending. Oh, sorry. Okay, sorry. So let me go a little bit before. All right, so the bank has to be indifferent between two strategies. The first one is, imagine they have one sol like the notation is why I just put it here. So imagine the bank has one sol. It should be indifferent between lending this one sol, and imagine at a rate of y. In t+1, it should have 1 plus this rate, right? It should be indifferent between this strategy and another strategy, which is to lend, instead of lending in soles, lending in dollars and hedging the exchange rate risk. So what does that mean? If the bank starts with one sol today, what it's going to do is going to use that sol to buy dollars. So it's going to get 1 over ST. ST is the exchange rate in soles per dollar. So it's going to get 1 over ST dollars here, right, today. And what it does, it has to lend it. It lends it at a rate of Y USD. And tomorrow we'll have 1 over ST, the amount that it in dollars, times 1 plus the rate. So this is in dollars. So what happens is that the bank needs to do is to really here at T+1, like in order to lock into solid returns, what it has to do is that as of today, it engages in a contract. Sorry, it's not working. So it's okay now. Okay, so engages in a contract to sell those dollars as of today for tomorrow, right? So this return, the bank will sell dollars at a rate on FT, and tomorrow it should know today that you will get this return in soles. And the bank should be indifferent between these two strategies because it should yield a risk-free return already in the currency. So if CIP holds, what happens is the return of lending in soles, which was the red one, should be indifferent with the one of lending in dollars and hedging the exchange rate risk, which is this Y forward rate, which is called also the synthetic rate of lending in lending soles. And so the cross-currency basis, which measures the arbitrage, the level of the degree of arbitrage, is just the difference between these two rates, right? So, and I'm here denoting it as the synthetic soles rate minus the soles cash rate, right? And I'm going to be measuring these deviations, this cross-currency basis, and I'm going to be looking whether the transactions that banks need to do are consistent with this in the first step. Yes?
Clarifying question. So I guess the covered interest rate parity generally has been stated in sovereign bonds returns. And here you're thinking about the rates at which banks lend. So
no,
just a
question.
clarification on that.
So no, right, like it's no, I mean, of course, it is how you're thinking, but I'm not going to be measuring with lending in soles yet. I'm just going to be looking at what they do in the trading desk, which has to do with money market, exactly how banks do it, which has to do with money market rates, right? So, and then I'm going to be seeing how does that shift, maybe probably because it changes rates in the base, even in the money market, and then that could translate to credit rates, but I don't have interest rate on credit rates. That is. But right now, when I'm going to be looking at trading, it's going to be with sovereign debt. Right, so if banks are going to be arbitraging, so just to see if this is consistent with banks doing the arbitrage, we should see that banks, as the cross-currency basis increases, then it is more profitable for a bank to lend soles synthetically and borrow soles cash. So what they will do is that they will borrow this one sol, and they will just do the synthetic dollar rate, which involves buying dollar spot, investing this at a dollar rate, which I'm going to be using also the money market rates, not the credit yet. And then selling these dollars forward and investing the dollars in trying to have a risk-free. So this is like the review of the current interest rate parity. So let me just go into the data. So the data here that I have is from February 2005 to February 2013, excluding the NBER crisis, because what I want is just to look at this an analysis that doesn't include crisis period, so it's not really related to crisis. I finished in 2013 because there were many confounders in 2013 that I think everybody from the central bank can also talk about here in Peru, which was that after 2013 there was the taper tantrum, and the sol depreciated quite a lot, and then there were a lot of policies done at the Central Bank of Peru, which involved trying to de-dollarize the country, which meant that banks had some limits in terms of how much they could lend in dollars, so that would affect my outcome variable. And at the same time, there were also regulations on the forward market. So it becomes a little bit messy if I wanted to do some identification. I've expanded the data until but just to have everything cleaner, right now I am focusing until 2013. And the data sets that I have is that I have bank level data, which has all of the forward contracts of banks. I have their positions on money market accounts, and I have the interest rate paid on deposits as well. So I can try to see if the transactions they're doing are consistent with them arbitraging the covered interest rate parity. I also have firm bank level data, which involves the credit registry of Peru. So it has, and for this I have only the loans to firms with $100,000 or more because of confidentiality issues. Small firms, one can identify it with a person, so I didn't have access to this. But I can merge banks' transactions of what they're doing in terms of their trading with the credit registry to see whether the bank that arbitrages more versus less end up lending more in the currency they don't need. Yeah, so let me go. The transactions that I'm going to be using are the ones that are related to the CIP deviations themselves. The ones that, I mean, in terms of counterparty risk, what I'm going to be measuring here is going to be the best type of risk-free that I can. So, for example, and I'm going to be showing in the results exactly what I mean with what are the liabilities and the assets. But basically, they're going to be borrowing in short-term deposits, in term deposits of, like, for example, institutional investors. That's going to be in terms of what they are lending. But on the asset side, where they're investing. So in terms of the soles assets, I am looking at, for example, the central bank soles certificates of deposit, which are in Peru is the most risk-free that you can have for a bank. In dollars, what was very common was deposits at the Central Bank of Peru in dollars. So that was like the counterparty risk is the Central Bank of Peru, which is the most risk-free that we can have in Peru, right? So this is what I'm going to be looking in terms of how much each bank arbitrages. I'm trying to mimic the best I can in terms of this aspect. And the CIP deviations are not really driven by counterparty risk. As you can see from the charts before, they were positive and negative, so it doesn't really have to do with that. In most of my period, it was negative, which actually meant that investors who don't have access, foreign investors who don't really have access to the Peruvian market were willing to have even a lower return on their soles investments than the cash rate. So it was not even counterparty risk. In most of this time, which is where CIP deviations are negative, I mean, there were some positives as well. Most of this was it's a period in Peru which was, they were fighting to invest in Peru, and there was a lot of carry trade in Peru as well. All right, so the first step has to do with how the transactions are done, right? So imagine the cross-currency basis, which recall that it was the solid synthetic rate minus the dollars. If this increases, what we saw from the review is that the banks will want to borrow in soles and lend in dollars. And here I have the borrowing, the currency exchange with spot and forward position on their lending side. And what we see is that as the cross-currency basis increases, what happens is that banks are going to be borrowing more in soles. I have split so these are just correlations, right? So what I'm going to be doing is, like, in the dependent variable, it's just going to be either borrowing like any of these currency exchanges or lending. And I'm going to look at the correlation with the cross-currency basis, and I'm going to be separating on when the cross-currency basis is positive or negative, just because we might think that it might be stronger when it's positive, because that requires banks to borrow in soles, do the transactions exactly as I mentioned. The other one implies the opposite, but still, as it increases, we should see similar results. And what we see is that the correlations have the expected signs. So they borrow more in soles, they borrow less in dollars. So it's not something that, oh, they all need cash or something. They borrow more in soles, less in dollars, as we expect here. They buy dollar spot, so their spot dollar position increases. They sell dollars forward, as we So they buy spot, they sell forwards. And the results are also stronger when the cross-currency basis is positive, which is what we would expect. I estimate this at the aggregate level and at the bank level, just for, so here I have the bank level is similar, but it's a little bit weaker at the bank level. Now, why? The reason is that there's a lot of bank heterogeneity. So not all banks arbitrage in the same degree. So using this, I try to look at whether, like, how much each bank is arbitraging. What is the degree of arbitrage? So for that, I construct a variable that is called, I call it matched, but it's basically matched assets, basically, which means that if any bank is doing the arbitrage, there are two things that we should think that should have the opposite. There's one transaction or two transactions that have to happen. One is that they need to do a transaction in the spot market, and they also have to do a transaction in the forward market, right? Depending on the sign. But as the cross-currency basis increases, right? So we should see, sorry, they should do this, and these two should sort of match, right? One is the present value of the other one, but it should be very close to each other. So if the banks, if the cross-currency basis increases, banks should be buying more soles, but also selling forwards. So my matched variable basically matches is the amount that there's an increase in the spot and a decrease in the forward of similar amount. That is basically what I have as a proxy of how much each bank is arbitraging, and I scale that based on their assets. Just because of how I constructed this, the match variable is going to take a positive, it's going to take the sign of the spot, just because that allows me to have a positive correlation with a cross-currency basis based on the transactions that they have. And what I do in a second step after looking at this variable is I estimate a bank-specific sensitivity to arbitrage, which is just going to be how the if the cross-currency basis increases, how much basically this matched variable, which is a proxy of how much they arbitrage, scaled by their assets, how much each basically moves, right? So I'm basically trying to adapt or get this beta, which is specific for each bank. For each bank, I run this regression, and I try to see what is their sensitivity in terms of how much they arbitrage. And if a bank B arbitrages more than the other one, it's going to have a more positive beta, a bigger beta, right? So, and if banks are arbitraging in general, because of how I constructed the matched variable, that is, it has a positive sign, it has the sign of the spot, basically, we should have a positive correlation. And this is what I see. So, first of all, the matched assets and the cross-currency basis are positively correlated, which is what we would expect if the banks are arbitraging. And at the same time, we see that there's a lot of heterogeneity across banks in terms of their beta. So here I'm plotting the kernel density of each bank's beta. And what we see is that typically they're all positive. There are ones that are very, very close to zero, a little bit negative, but it's basically banks that don't arbitrage. And there's a lot of heterogeneity, and there are there are different groups here, right? So I am going to try to exploit this arbitrage heterogeneity and trying to see if those banks that arbitrage more are going to change their lending by more in the currency that they need to borrow. So reduce the amount of lending in the currency they need to borrow to do the arbitrage and substitute it for the other one. Right, so this is the first step. It's just that there's, the summary is that there's the correlations are as expected if they are doing this arbitrage. The currency that then the second step is just, okay, this currency that they need to do the arbitrage, they do the arbitrage, is the currency that they need to borrow scarce at the time that they need it? And the answer is yes. So what I do here is I estimate the correlations similar to the previous step. I look at the correlations between the cross-currency basis and different aspects of soles and dollar liquidity. So I look at I call it like the deposit spreads, which is just the interest rate minus the monetary policy rate, because I don't want anything related to the monetary policy, because the central bank increases the monetary policy in Peru, that increases the cost of funding in general in soles. So I just want to take away all of the monetary policy effects from this and just look at maybe the markup. How much are they paying over the monetary policy rate in order to get funding in that currency. So what we see is that as the cross-currency basis increases, we mentioned that the formula was the solid synthetic rate minus the cash rate. So banks should be trying to borrow more and more soles. And at that time, we see that they're paying more and more for their deposits in soles. These terms are pretty positive. At the same time, they pay less in dollar deposits. And what we see is that it is scarce because we also see that there's less soles liquidity in banks, in soles, but more in dollars. So it's not like a structural problem of the bank of having particular set of liquidity. It is just in one particular currency. So I do this at the aggregate level and at the bank level, right? So what we see is that the currency that banks need to borrow to do the arbitrage seems to be scarce at the time they need to do it. So with these two sets of correlations of the first step and the second step, I go to the third step, which is just trying to see, okay, this setting, can arbitrage in the CIP deviations affect bank lending? So in order to do this is just for you to remember what should be the expected results.
Can I have a quick question? How should I think about other currencies? Like, I can also do this, I guess, with the euro or whatnot, no? Is that, so when I imagine that the euro and the dollar are correlated positively, is this about something about the dollar, or is something about the whole basket of currencies that these banks in Peru could be trading with?
So right now, I've mentioned, I'm going to be focusing only in the ones that banks in Peru can trade, right? Which they trade some of the few Latin American, but it is true that it's correlated with other like the dollar is correlated with other currencies, right? So here, because of what my channel is just going to speak directly, because the data is also what the banks are trading, it's just dollar versus soles, and here, as far as I know, but maybe the central bank they know more about this, they typically would lend either in soles and dollars, not really like euros or something else. And dollars, it was back in that time, I think the central bank has done a great job also decreasing the dollarization. But so far it's been, before it was, during this period, it's you go to a bank and they ask you which currency you want to deposit in dollar, soles, or lending. So it's just basically on these two, right? But the results, I think, can aggregate to other currencies as well. All right. So,
I have another question. What's the regulation that is limiting the arbitrage so that the deviation doesn't go away? Is it the capital requirement for the balance sheet? Is it restrictions on international flows? Do you have an idea of that?
So yeah, I tried to analyze a little bit on this. A lot has to do, it seems to be that a lot has to do with not as much on the regulation side. For example, during here is not Basel III, or it was not even implemented, and even so, I think right now they're implementing it now. I think there's a combination of things, but one is foreign flows demanding one side of the trade, and trying to do carry trade in that dimension, and banks sort of getting some profit out of it because the markets are segmented. So it is very hard, for example, if you are a foreigner, if you want to arbitrage this away, to just go and do this exactly as a local bank, because the local banks have an advantage. They can access the central bank's certificates of deposit, which at one point it was restricted for foreigner, or they have to pay a fee for that. And then there are different market segmentations that really, I think the few banks that trade, and there's an interbank spot market. It's not everybody gets access to that spot market. It's just interbank. So there's some market segmentation that I think can explain this, and we can talk a little bit more on the demand side. I think there are, of course, some liquidity issues and things that happen, but most of the results that I've tried when analyzing this have been on how the flows are, and basically banks having some margin on that.
Another.
And your betas must be related to how active these banks are in the money market, their balance sheet, their spread over the central bank rate?
So the betas are, the beta is just also over assets. So it's not really just a matter of size. It doesn't have to do also if it's foreign or not. The ones with larger betas could be even local banks and foreign. They are not necessarily the biggest ones. When I tried to understand what was going on, what I saw is that the banks that have counterparties that typically take the opposite, so more of the variety of different types of counterparties, the ones that, you know, in the forward market, you have that they have companies that buy and sell dollars forward. They are the ones with larger betas. What I can conclude from that, but this analysis is like very correlation is and with few banks, so it has some caveat there. But from what I could maybe point to in that direction is that whenever banks are doing the arbitrage, they take one side. And if they want to, at some point, they want to offload that part of the trade, it is very easy for them to do it maybe without that much price impact if they have typically customers to whom they can offload that. And those banks I see that they are the ones that engage more in the arbitrage. Right? So going back to the results, so what should we expect? We should expect that as the cross-currency basis increases, the banks need Soles funding to do the arbitrage. So what we should expect is that as the cross-currency basis increases, we should see Soles lending decrease and dollar lending increase, right? So banks substituting one for the other one, and vice versa when the cross-currency basis decreases. But trying to understand this is challenging because it has, the cross-currency bases themselves are endogenous. So the CIP deviations are affected by macroeconomic shocks that affect banks' decisions to lend. It affects firms' investment opportunities. And at the same time, you can also think that banks themselves, like their hedging or their strategies on what they do on the forward market, end up affecting the cross-currency basis or sort of a reverse causality, right? So because the banks may just want to lend in one particular currency and then they decide to hedge in one way, the demand in the forward for that hedge affects the CIP deviations and so on. So there are many confounders here. So what I try to do to mitigate any concerns on these directions is the following. First of all, the fact that banks' decision affects banks' decisions to lend. Okay, I'm going to be comparing, like that is affecting, all of these macroeconomic shocks are affecting banks. The first step that I do is I exploit this heterogeneity across banks for the same time. So this assumes, in some way, that all banks are affected in the same way with a shock, which might not be the case. So then I do some robustness checks with only the very, very similar banks, and I do many more checks on that. But one part is just, I'll be comparing how one bank arbitrages, like changes their lending relative to another bank at the same time. So them supposedly affected by those shocks. At the same time, firms' investment opportunities, I mean, these CIP deviations maybe are related to changes in firms' investment opportunities. So what I do is a within firm month analysis. So I look at how the banks that arbitrage more, how do they change their lending to exactly the same firm on the same month relative to one that arbitrages less. And how do I tackle the fact that banks' trading and lending decisions could itself affect the dollar-sol CIP deviations, is that I'm going to be instrumenting the CIP deviations of Peru with CIP deviations of other countries, which I'm going to be taking the average of Mexico and Chile, right? And I see that banks, I mean, the local banks in Peru, the idea is that local banks in Peru don't really arbitrage, don't really trade other currencies like the Chilean peso or Mexican peso. And so just what I'm going to be focusing on, and let me just go, the second stage, which is the Boolean regression, is like the first stage is just the instrumenting the cross-currency basis of Peru with that of Chile and Mexico. The second stage of the regression, I do a two-step least square, as you can see. In the second step is exactly what I mentioned, that is, I'm going to be looking at how much a bank lends to a firm F on a particular time t. The coefficient of arbitrage is this alpha 1, which is the interaction of the cross-currency basis in Peru in the previous step, times the arbitrage intensity. This is each bank's beta. All of this is instrumented with the cross-currency basis of Chile and Mexico. And I'm going to be using bank firm fixed effects to control for any relationship between a bank and a firm. I'm going to be also using firm month fixed effects. So, sorry, firm and a month fixed effects to control for any credit demand. I also have some controls at the bank level, but then I also do the analysis on very similar banks as well, just to avoid any confounders. And what I find is that as the cross-currency basis increases by 1 percentage point, what we see is that the banks lend less in soles, which is what we would expect, lend more in dollars. In terms of total, doesn't really change that much, but basically the difference between the dollar and the sol changes a lot. So as the cross-currency basis increases, what we see is that banks are changing their allocation of dollar versus sol. So here the regression is again looking at one bank versus the one bank that arbitrages more. So as the cross-currency basis increases 1 percentage point, those banks that arbitrage 1 percentage point more of their assets, they change their lending in this way. And it's robust to various specifications. So there's some potential confounder in terms of, one can think about, okay, I thought here's a little bit different, but yeah. Okay. All right, so in emerging markets, there's a positive correlation between the exchange rate and the cross-currency basis. And this is seen in here. So here I'm plotting the change, the 1 year, or it was a 6 month, I think. Well, no, it's the 1 year change of the sol dollar, which is when it increases, it depreciates, and decreases, it appreciates. And I'm also putting the cross-currency basis. So one potential confounder is that correlation between the cross-currency basis and the spot. And the confounding is the following, is that as the sol depreciates, if the sol loses value, what do households do? Households will want to switch their savings to dollars, right? So they want to switch to dollars, so banks are going to, so one natural aspect that can happen, just because households want to save more in dollars, is that their lending in soles will decrease, right? So and the CIP channel, which is the one that I've shown you, we can also say that the banks, when the cross-currency basis increases, banks borrow more soles to arbitrage, and banks decrease their lending in soles. So it's both have the same, yield the same result. So this correlation, you might think, could be explaining my results. But for this to be the case, so I showed that this is not really the case, or what is the main driver, because for this to be the case, one needs to, this effects channel needs to affect more the banks that arbitrage more than those ones that arbitrage less, because all of my results is a comparison between banks, the banks that arbitrage more versus the banks that arbitrage less. It's not like something in general. So here, I look at how the banks arbitrage, how does that correlate with how much their saving, the household saving or deposits in one or the other currency affect them. And what I see is that, so here I have, for example, those banks with low beta, medium beta, like this, the beta is the sensitivity to arbitrage, and how does the soles deposits relative to the assets, how do they change with a 1 percentage point of depreciation? And we don't see that the ones that are most affected are always the ones with larger betas, right? So here we see, in terms of soles, are the ones with lower betas. In terms of dollars, it's actually the medium ones. So it's not really seems to be affected. I also run an error regression where I'm just going to be adding the log of exchange rate times the beta. And actually I'm adding that line to the main baseline regression, and we see the coefficients are pretty stable. They go in the same direction, but it still don't really reflect the results in the paper. So just to conclude, the CIP deviations can have important effects in terms of lending in emerging market economies where there's some partial dollarization. So, and the main mechanism of what I try to put in this paper is like, just give at least maybe some topic of conversation of maybe these arbitrage opportunities affect the real economy. And I propose a new channel on this, which is that banks that are actually arbitraging the CIP deviation, the funding that they might require is scarce at the time they need it. And this may affect how they allocate their lending in one currency versus the other one. And even though I don't have data at the firm level, right? So I cannot really see how real outcomes go and what happens. But based on all the literature that has been done, which is great work on how depreciation affects firms that are borrowing in foreign currency and how does that affect investment and employment and so on, there is a mechanism through which the channel that I'm proposing could end up having real effects. So thank you so much.
Thank you very much, Lorena. The discussant, Juliana Salomao.
So thank you so much for the invitation. It's been a pleasure to be here in Peru. And I'm looking forward for the next 2 days of great papers. So what is this paper talking about? So the paper is going to propose a new channel through which deviations of the CIP are going to affect bank lending. The channel is going to be that when banks are trying to arbitrage these deviations, they're going to need some currency to do it, and it's going to affect the way that they lend in terms of currency composition. So the paper is going to provide the suggestive evidence of this channel in Peru by showing that banks exchange and money market transactions suggest that they arbitrage CIP. Bank funding in the currency required to arbitrage becomes more scarce as these deviations increase. And then banks with higher sensitivity is going to shift their currency composition of lending in line with what would look like these banks are arbitraging. So let me give you a detail of how the paper measures the CIP deviation. This is going to be from the paper's equation 3. They're going to measure CIP deviations as X, which is going to be the interest rate of dollar annualized, and then the forward over the spot minus the cash interest rate in solids. The way the paper measures it is going to be using interbank rates as benchmark. I think these interbank rates are overnight or very short term. It's going to be a daily rate that I think, the paper doesn't give a lot of details on how exactly they calculate it, but my guess, talking to people that know this data, is that they use overnight rates. It's going to be daily rates that are going to be average over month, and then it's going to be per annum, so then they're going to adjust this by 1 month forwards. This is kind of a little weird already because these are going to be annualized rates adjusted by 1 month forward, so there's already some maturity mismatch there. But the suggestion that the paper does is that this is what traders use to arbitrage. It's fine with me. If traders do it this way, maybe it measures something. I'm not sure what. But then the channel it's going to measure is going to be that if CIP is negative and declines, banks want to borrow in dollars and lend and invest in soles. If dollar financing is scarce, banks are going to divert funds away from lending, and that's going to impact the composition of banks lending away from dollars. So as CIP, which is mostly negative during the period analyzed, declines, banks are going to need dollars to do the arbitrage, so they're going to lend less in dollars. It's kind of nice because if this is true, CIP of banks arbitraging it, it's going to end up generating some adjustment that it smooths away the fact that firms are trying to arbitrage. One thing we can ask is that, as though the paper shows that it impacts lending, does it impact lending rates? If it does, how should it impact? And it's nice because it's adjusted by smoothing it. So let me show you. If CIP is negative, so everything is going to be for negative CIP. In blue, you're going to see for a positive CIP, it goes the same way. If CIP is negative and it declines, banks need dollars to finance, to do their strategy. If dollars are scarce, lending rates in dollars would decline. This would imply that dollar lending rates should go up, right? So it kind of automatically stabilizes the lending rates in a nice way. This would lead to a loan level CIP to go up and become less negative. So banks' arbitraging channel proposed by the paper should generate a negative correlation between the bank CIP, measured by interbank rates, and the loan CIP. So although it says that there's no data on loan, actually the Bank of Peru has really nice data on aggregate levels of loan for some of the period analyzed, specifically for post-2010. So what I do is that I go in, I get data from Bank of Peru's data, aggregate data on US dollar and soles lending rates. I'm gonna do US dollar minus soles, and the same thing for intrabank. This is gonna be overnight. I'm gonna do monthly averages, and everything is annualized. So here I don't adjust by the forward rate. If this is a daily rate, the forward interbank should not be adjusted, but sure. So if you wanna adjust it by the forward premium, you can just adjust both rates. But what we see here is that interbank rate moves a lot. This is gonna be the red dashed line, while the loan differential is quite stable, right? The other thing is that although the channel would predict that we should see a negative relationship between these two, the relationship is positive and quite strong. And this is exactly the period post global financial crisis, 2010 to 2013. So the correlation between the two rates is positive, 0.72, and it's not gonna be driven by selection. So for some of this period, I do have loan level rates that in my work with Vittorio Vacina and Brian Gutierrez, and we see a similar correlation. It's gonna be an appendix of our paper. So what we see is that the following. It doesn't look like there's evidence of the banks arbitraging in rates. It mostly that these interbank rates are benchmark rates, and that's what explains this positive correlation. Does this mean that banks are not arbitraging? No, it does not. They could still be arbitraging. They're not doing it, a lot of it, so that they're not impacting rates, right? And this is consistent with the literature. The literature does say, look, these banks cannot arbitrage a lot, and that's why we actually, as Andy was pointing, we still see that deviations are not eliminated. They're still there, and they're big, right? So how big can the impact be on loan composition? So this is exactly what Lorena does in her last step 3 of the analysis, where she does the IV. And it seems from that it does impact loan composition quite a bit, which we can ask, could this be that, we know that the dollarization of loans in Peru is large. Could we see that banks arbitraging is explaining the level of dollars, right? As the CIP goes down, banks wanna change their dollar composition. So let's see. So this is what the paper says. Banks that allocate 1% more of their assets to arbitraging, 1% percentage point increase in the cross-country basis, will increase their lending in dollars by 11 to 44 percentage points relative to the soles. By reading this is going to be doing within banks, it looks like this is really large, right? Can this explain double-digit dollarization that we observe in Peru? Why? Well, because this is going to be figure 2 of the paper. In red, you see here, this is going to be the CIP deviation that you document in interbank rates. This is going to be between 0 and 2%, negative 2%. So these are big deviations. And we see here that, for example, in 2010, this deviation is varying a lot. It's going to be varying between 0 and minus 2%. What happens to dollarization in Peru? Again, Bank of Peru has amazing data. I went in and I calculated the dollarization level for the exact same period. This is going to be the share in the graph over there in blue. And we see that, dollarization was really high in 2005, 75%. And then it dropped in 2010. It's between 50 and 55%. So it's wide. But the variation, while we see that the CIP basis is varying between 0 and 2 negative percentage points, dollarization in 2010 only varies very small. It goes, the maximum of is 52.64%, and the minimum is 51.76. Then in the end of the paper, kind of right before conclusion, Lorena gives a better analysis of what happens. And it says, look, a 1 standard deviation increase in the basis makes banks that respond by arbitraging 1 standard deviation increase in lending by 77 percentage points, making the share of dollar borrowing increase by 2.48 basis points. That means that the share of dollar borrowing varies by 0.0248%. So it is actually a channel that talks about high frequency, very small changes in dollarization. This begs the point, are we trying to explain trend and levels, or are we trying to explain wiggles, right? When I teach my students about patterns, I talk about the wiggles. And this is really a paper about the wiggles in dollarization. So here's the dollarization between 2010 and 2020. Again, data from Central Bank of Peru. And the wiggles are not the biggest thing you see here, right? What you see here is actually levels and trend. And you can ask, what explains level and trend? Well, this is from my paper with Victoria and Brian. And what we see is that what explains levels and trends is actually deposits. Banks are going to be matching the deposits, the assets and liabilities. This is from our paper. This is, again, using Peruvian data. And what we see is when we look at the balance sheets of banks, banks are going to be matching the dollar liabilities and their dollar assets very, very closely because of regulation. And the majority of the dollar liabilities are deposits. These are not intrabank. Intrabank market in Peru, it's about 2% of the total balance sheet. So why are they lending so much? Well, because Peruvians really like to keep their money in dollars, especially in the beginning, now less so. And banks are not able to have a mismatch in their balance sheet. So what happens? They pass through whatever they see in their deposit markets from highly inelastic depositors to their lenders. And that's what explains the trend and the levels of dollarization, not banks' arbitrage. So overall, I think this is an interesting paper for explaining marginal changes in dollarization. Would be really helpful for the paper to make that clear. Thank you.
Thank you very much, Juliana. Lorena, maybe you can come, you can answer some questions or go to the podium. Let's collect a couple of questions and then, okay, so let's start with your, a quick reaction to Juliana.
All right, so thank you, Juliana, for your comments. So in terms of, first comment was on measurement, on whether interbank rates, using interbank rates. I've also used many other robustness checks with deposits and so on. It holds, and the basic capture was that banks are trying to do the trading. Now, in terms of rates, I mean, I think it's important, like as I was showing in the paper, this is mostly, the data that I have for is larger firms, which are the ones that are changing their dollars and soles for that. So, and a large part of the Peruvian firms only borrow in soles, particularly those ones that borrow basically from very, very small banks, cajas, and so on. So I think like to understand the rates, one has to do, I mean, in order to understand what's going on, one has to look at one has to do basically an analysis of a risk-adjusted. We will be needing actually to have loan-level data to have risk-adjusted rates for each one of the firms, and that this is not really affected by risk. And okay, so and then in terms of the levels or changes, I mean, my whole analysis, I mean, is going to be extracting any effect from trends or any shock at the macro level that could be affecting these trends. Because what I do is I do an analysis of one bank versus the other one. So I just want to remove any, because if we look at levels and what could be driving the levels, then there are tons of confounders. So what I try to do is eliminate those confounders by looking at the relative change of one bank versus the other one, right? So the whole paper is not to answer any trend, because trends actually are quite hard to, I mean, can be so many different aspects that of macro shocks that can say something. So in order to have some document on proper causality, this is what I'm focusing on, and this is what my results are speaking to, right? So yeah, I think so. That's in terms of levels, and which was the main point.
Thank you. So let's open for questions. Let me start here. So I guess I found it fascinating, all your results. A question, and maybe this is related also to Juliana's points, is it would be interesting to think about sort of the aggregation of it, right? Because if you think about macro effects of these type of CIP deviations through the channels that you are considering, what are your thoughts on how could one sort of think about this aggregation?
I mean, I think that's a very good question. So in terms of aggregation, I think, I don't know if one can look maybe even at I have to think more on the aggregation side. But I think like one can think about if one tries to do this on the aggregate level, I think in terms of models that could help, right? So in order like to put this channel, I guess, in a model and try to see whether in different, how does that behave even in different environments that which might change, and the different importance at different points in time, which could also be at one point in time. I mean, for example, after 2013, and I think that's there was huge depreciation. I think that maybe the FX channel that I was showing later that predominates, because after 2013, 2016, and so the depreciation was so large that everybody wanted to have their deposits in dollars. So I think like when aggregating, we should see at different macro regimes and when this becomes more or less important.
I mean, one just additional thought is, so in structural models of financial frictions, for example, where, you're providing a particular elasticity in terms of, key parameters that would drive those mechanisms. And so, perhaps your empirical estimates could be used to inform those elasticities in structural models and then use the model to aggregate.
No, that's great. Yeah, thank you.
That's a one. Yeah. Any other question? Yes, Pablo.
Very interesting. Very interesting paper. So I was wondering if you could elaborate more a bit the causality part of the paper, in particular in the instrumental strategy that you use, what you expect in terms of the exclusion restriction, and yeah.
Oh, thank you. So yeah, so regarding the instrument, I mean, the problem that I felt there could be an issue is that if banks, for example, decide to lend more in dollars, right, for some particular reason, then they might just they decide to hedge more those dollars and sell those dollars in the forward market, and that would create some pressure in terms of the CIP deviations, sort of putting downward pressure to the CIP deviations, and I don't want to have this effect roaming around, right? So what the instrument is trying to do is to try to isolate any effect that is coming from if banks decide to lend in dollars, that whatever the aspect or the fraction of CIP deviations, the sold dollar CIP deviations, that is not coming from banks deciding to hedge in that rate and, for example, putting downward pressure to that. So in terms of putting the CIP deviations of other countries, which banks, I have the forward level data and they don't really trade, what I'm trying to do is like look at the component that is sort of common across emerging markets, because as I showed also in the first steps, is just there's an aggregate component, offshore component, or maybe that is affecting many markets at the same time. So in terms of what is the how this should work, is like I am thinking of you can think about an exogenous shock that is not going to be affecting necessarily how banks decide to lend or through the CIP deviations in Peru, because it is a shock, for example, from you can think about it like the US rates, in particular in part of my sample, the LIBOR decreased a lot in the just pre-financial crisis, just when things were heating up, but it was not really a crisis. And then what happens is that there were a lot of flows to emerging markets because of seeking yield of all these foreigners. So I'm looking at the CIP deviation, like how banks are changing their lending based on this CIP deviation portion that is based on outside shocks like this one, right? So it should not really be affecting lending through a different channel.
Fernando?
Hi, Lorena. Thank you very much for a very interesting paper. I want to make a question about something that also Juliana brought up about the maturity, and I was wondering if you could use it to your advantage, actually. If you could have any information about the maturity of the loans that these firms are making to the firms in dollars, we could expect that your results are stronger from when these loans are shorter term, closer substitutes to the CDs, where when they become weaker when they are making very long-term loans, which you could imagine that could be driven by something else.
Yes, thank you so much. I would love to have that. What I have in terms of the credit registry. So now the banks are the bank regulator is starting to collect more data on rates and on the terms, but this didn't used to be the case, and the credit registry only shows the balances that a firm has in dollars and in soles by different types of loans that each bank does to each firm. So I would have loved to have the terms here, but I don't. So right now I'm just looking at the aggregate. But yes, one can think about it in those terms as well, and I would expect that as well. But maybe like for future work. The problem like with future dates, it's just that there's so many confounders after 2014 with all of these, like the taper tantrum and then the regulations that came in the de-dollarization regulations. Then the central bank also, like there were some reserve requirements set on forwards as well. So it's very hard to do this analysis post that, but probably maybe with different country as well. Thank you.
Okay, the last question.
Yeah, so you have to press the thing here.
No, yeah, but it wasn't working. So I have a question. Do you have you have data from the balance sheet on with your match of how much they were trying to arbitrage, right? Do you have an idea relative to the assets of the bank of how big these arbitrage profits are?
So, I mean, they have varied quite a lot over time.
Yeah.
So there was one point in time. So I right now in my sample period, they became quite large also in the crisis, which is sort of surprising. Yeah. But I have to, I don't remember right now the number, but it became really important. For example, 2015, because the central bank did some exchange rate swaps as well, and there was very profitable at that point. When I was talking to traders, it became like one of the main, very important source of revenue. But I have to. For my period, I have to check. I don't really know the number yet.
I think it's important because you're saying this deviation of CIP have allocative effects on credit and so on. So if you think that they're important from the point of view of allocations, you have to think that these arbitrage opportunities they're profits that are big. Yes. So that because if the profits are tiny, because if you move more, you run into a restriction or the price impact of the trade or stuff like that, then we shouldn't care that much about the CIP deviation. So it's since I'm going to have a sense of how important these profits are, it's important.
Something that is important to note is that it's not that they are necessarily large because of like the restrictions of liquidity and I mean, partly could be, but I see that the CIP deviations in absolute value and the profits are positively correlated. So they do, but which it doesn't really show a supply constraint. It's more on the demand side that they, at points in time where there's a lot of demand maybe from foreigners, then this becomes that the CIP divisions become big and they actually profit quite a lot. But I have to check that. But something that I wanted to point out is that doesn't just only matter the influence on the profits, but how even changes because of liquidity, maybe changes in these profits, how they feed back into rates and equilibrium results, which could be not even related necessarily, very closely related to the profits.
Okay, thank you very much. We'll continue this conversation. We'll be back. We have a break now. We'll restart 10:15. Thank you.
theory of hard and soft sovereign defaults. Pablo, you have 40 minutes. Thank you so much for coming.
So, can you hear me? Yeah, you can. Thank you very much to the organizers for having our paper here. We are really happy. We are working on a revision of this paper, so your feedback is going to be critical. Needless to say that I'm super happy to be here because most of the experts on sovereign default are here, so that makes it quite important for us. And the second reason why we are very happy to present is because I think in terms of policy impact, this type of models are quite important here in Latin America because we face sovereign defaults quite often. Okay, so let me tell you what is this paper about. So here in this figure, what we have is data coming from a paper, a recent paper by Trevesh and Sabel. And essentially what they do, they compute haircuts or how much was lost during a renegotiation of the original debt that lenders gave to some countries in emerging economies. And then what they do, they classify the severity of the default event by the amount that was lost. And they say everything below the median, they are going to call it a soft default. So that's the red line that you see over there is the GDP trend following the default episode that is normalized at 0. The number, the GDP is normalized at period -1. This is yearly data. The blue line is when the haircut is above the median, and that's what they call the hard default. And you can see immediately that the path of these two default events are quite different. The soft default, you see that there is some stagnation around the default event, but eventually the countries in that sample recover. On the other hand, you see the blue line is about 5 years from the default event when the country is going back to trend. Okay? So in this paper, we want to think carefully about the reasons why countries experience these two types of defaults. Okay? So what we are going to do in this paper, we are going to do two things. From the empirical point of view, we are going to give more thought about these hard and soft defaults. And we're going to show you that if you look at the real exchange rates, there is also an important difference in how much the real exchange rate depreciates in a soft versus a hard default. And the difference is about 30 percentage points. Moreover, you're going to see in a moment that the default duration is longer following a hard default than a soft default. Then in the theoretical part, and that's where we spend a lot of time in the paper, we think carefully about what can be potential drivers of these sovereign soft and hard defaults. The model is going to have a theory that allows us to have endogenous haircuts and also endogenous duration of default. Importantly, we tried to push forward these models that Christina has been developing over the past 20 years. We tried to push them to the quantitative terms. So we are going to do a kind of estimation using Argentina data because we want to back up what are the drivers of these soft versus hard defaults. The key ingredient in the model is going to be something that Mark and Gita proposed many years ago. There will be growth shocks in the model. So there will be transitory shocks and growth shocks. And these growth shocks are going to be the key drivers of these hard default episodes. Importantly, we're going to allow for exchange rate fluctuations in the model, and this is going to create an additional channel that will make the sovereign default quite costly in our model. And as a result, you are going to see that this endogeneity of the real exchange rate makes or changes the way we need to introduce this cost of default when we have the theoretical model. Okay. So what is going to happen in this model is that the creditors are offered a large haircut. They are going to accept because they see that there are these growth shocks. And they know that the economy is going to struggle for a long time. So if I reject the offer today, I know that tomorrow the country is going to come again with a big haircut because the economy is still below trend. Okay? What is going to be the channel? Well, there is the bad growth shock. So there is a decline in the trend of GDP in the country. This is going to trigger a persistent depreciation of the local currency. Because debt is denominated in tradable goods, then automatically this is going to inflate the size of debt relative to GDP in the economy. Okay? And this is going to trigger these large haircuts. And because it's a large haircut, the creditor is not very happy. So this is going to endogenously give us these long durations of the default once we have the growth shocks. Okay? So I don't need to convince you here that the experts are in this room. So we related to three different areas of the literature. If your name is not here, please let me know. And I apologize in advance, but I think I did my best to enumerate everyone that is in the conference that has contributed to this one. Just one important paper that we relate a lot is the recent JPE by Cristina, Victor Rules, and Mateo Planas. Okay, so that's I'm going to make a few comments along the presentation to that paper. Okay. So let me give you one slide on these novel facts on what happens during soft and hard defaults. On the left of the screen, you have the real exchange rate. Again, we have this sample of countries coming from Trevesia and Sabel, and then we use the same classification. The red line is the average of these countries that are above, the haircut is above the median. And the blue, the green dotted line is the real exchange rate for those countries where the default is soft. And you can see immediately that the depreciation is quite different. The amount of the depreciation is different between the two countries. And you can see that it's on average about 30 percentage points change. The right figure is also telling you something about the duration of the default episode. You can see that in red, again, is the countries that have a harder default episode. You can see that the fraction of countries that are in default is very high, 2 years. Oops. 2 years after the default event, whereas the soft default, you can see that 2 years after the default event, is only 40% of the countries that are still in default status. Okay? So that's like the empirical contribution of the paper. So let me go to the model, where I want to spend some time to give you the details of what we do. Okay. So this is an Eagle's view of what the ingredients in the model are.
Can I ask a clarifying question?
Yes.
So the soft defaults had, like, what was the haircut, the average haircut between, or how, like, how soft and how hard they are?
So the 40%, that's the median.
Okay.
Everything above that is the hard default. Everything below that is the soft default. What is the average? I don't have it on top of my head.
That's fine. Thank you.
There are tradables and non-tradable goods in the model. All the action, as I said, is going to come from the tradable goods. So the tradable goods are going to have a stochastic behavior. They will have transitory shocks, but also importantly, growth shocks. So this is going to get us closer to the work by Mark and Gita. So we've been thinking like one way of calling our paper is to say Arellano meets Aguiar and Gopinath. So that's one way you can think of what we are trying to do. Okay? Debt is denominated in tradables. It's going to be a long-term debt. Here, we are going to follow what Chatterjee and Nguyen do to that type of long-term debt. There will be a maturity lambda of bonds that you have to repay every period. And then there is a coupon kappa on the remaining chunk of bonds that you don't repay. three agents. Consumers are going to be pretty boring here. They are going to consume, pay taxes. They don't have access to savings devices. The one that has access to a saving vehicle is the sovereign. Okay, so the sovereign is going to borrow, is going to do transfers or taxes on tradables to the household, and importantly, is going to decide whether to negotiate with the creditors, who are the last agents in the economy. Okay. So here you have the endowments in the economy. So on the left-hand side, you have the tradables. As I said, the tradables are the ones that are going to have all the action. ZT is the transitory shock, and gamma T is the trend of the economy. And as I said, the economy is going to be stochastic, so the growth rate of the trend of the economy is going to fluctuate following the law of motion that we call it here GT. Okay? The non-tradables are going to grow at a constant rate, mu. Okay? Obviously, because the growth rate of the tradables is stochastic, if we don't discipline, we don't put a connection between the growth rate of the non-tradables and the growth rate of the tradables, in the long run, the two can move apart. So we introduce this drift element. It's sort of a co-integration element that you see it over here. This is the one ET. That's the one that is going to force that in the long term, the two trends on average grow at the same rate. So that's more like a technical part for making tractable the solution of the model. Consumption is a standard. The household is going to use a CS aggregator to consume between tradables and non-tradables. Okay. So this is an overview of what is the negotiation process in the economy. The shocks are realized at the beginning of the period. For us, a period is a quarter. Okay, so the two shocks are going to be realized. At that point, the sovereign, if it's in good standing, can decide whether to negotiate with the lender. If it doesn't negotiate, then repays and moves to the end of the period, issues debt, imposes taxes, and consumers consume. On the other hand, if the sovereign planner decides to negotiate, then it's going to come to the table to the creditor and offer a haircut. Okay? The creditor at that point can decide whether to accept or not that offer. Now here in this step, we're going to introduce in a moment two types of shocks, and I'll give the intuition why we need those shocks. But for now, you think there are these shocks that make unpredictable from the sovereign planner to know whether the offer will be accepted or not. So then, because of these shocks, the planner has to be careful entering into the negotiation phase. So that's increasing the cost of doing default. If the creditors accept the haircut, then they get the part that is paid after the haircut, and then the planner can issue that if he or she wants. Okay, so this is in the model because we have the tradables, non-tradables, and the CES aggregator. At the end of the day, you can collapse the static block of the model to this a budget constraint that you see on the screen. And an important variable that comes in the paper, in the model quite often is a function.
Just clarifying, so if you offer a haircut and it's not accepted, you don't classify that as a default, basically.
No, that's a default. You're gonna if
it gets accepted, it's
not a default. If it gets accepted, then you're in good standing.
In the data, I guess that's probably.
We can talk later, but you can think when you have a haircut, then the haircut is computed once the negotiations are done. Now, how you can think about this renegotiation process? Well, you can think is how aggressive the planner is going to the table. Okay? So this object will come up often, so that's why I put it on the screen. Importantly, what happens in the model is that because debt is denominated in tradables, the real exchange rate that you see it over there affects the value of debt relative to GDP. So now here you can immediately see that a depreciation, which is an increase in the real exchange rate, the way we have it, inflates the size of debt. So what is going to happen in the model is once you declare default, because the debt is going to accumulate, there is an interest rate that accumulates debt. At the end of the renegotiation process, you are going to leave default with higher debt to GDP than before you entered to the default episode. And that's something that is nicely documented in this recent paper by Christina and Victor. Okay. So what is the problem of the sovereign if you decide to default? Well, you are excluded from markets. As I said, debt will accumulate in the model. The rate at which it's going to accumulate is RD. Okay. Now you can see here that if I default, I'm going to lose a fraction of my tradables. That's a chi. Okay? And it's also affected because I'm losing tradables, that's going to induce a stronger real exchange depreciation. And that's going to punish the sovereign harder. So now you can see in terms of this default cost that Christina put it very nicely a couple of weeks ago, that we have this love-hate affair. We need them, but they have this complex structure. Here, because this connection with the real exchange rate, you have a very simple default cost. You don't need these quadratic objects that we know from the work by Chatty and Borgiu that is needed to discipline these models to the data. So we think that this is a nice result of the paper that ex ante we didn't expect. Because there is this penalization, or you lose tradables if you're on default, our paper kind of touches what Enrique Mendoza and Vivian Yue did in terms that if you lose, you go to default, you lose access to international goods. You have to substitute for domestic goods. That substitution is not perfect. Hence, there is this default cost that is not a direct model. So that's what here is doing in rough terms. Okay. If you are in a repayment, this is the problem of the plan of the sovereign. Okay, this equation in the middle, that's the budget constraint of the sovereign planner. This is, as I said, the long-term debt a la Chatterjee and then Guyot. There's nothing special about that one beyond the fact that they were my colleagues and I learned from them, so that's why we introduce it. What is important in this equation is the second part, the expectation. So what happens, I pay today, but tomorrow I can decide whether to negotiate. Okay, if I negotiate, the block on top, the NT plus 1 is the negotiation variable. If it's 1, that means I'm going to negotiate. The value of negotiating is a V. If I choose not to negotiate, then I'm going to repay. That's the second term over here. Okay. We also impose this cost on this price base, so we don't have the debt dilution problem that Juan Carlos and Leonardo showed us a few years ago. So the value of negotiating is as follows. So the planner, if it decides to propose a haircut, is going to choose a haircut. That haircut is going to imply a probability of acceptance that I'm going to tell you in a moment. That probability for now is denoted by capital A. As you can see, depends on the size of the haircut. If the haircut is accepted, there is a repayment. Debt is reduced by the haircut, so it's less debt that you have to repay. If the proposal is not accepted, then you go to default in the economy. But importantly, remember that if I'm default, debt still accumulates at the rate RD. Okay? So let me talk a bit about the creditors' problem. As I said, the creditors' problems, once they get approached by the sovereign with a proposal haircut, well, with probability 1 minus alpha, that proposal will be rejected. It will not be considered directly. What do we want to capture with this? We want to capture the notion that lenders are committed not to renegotiate. They have a hard stance and they are going to say, I don't care with what you come, I'm going to reject right away that offer. This is going to allow us to have these persistent defaults that we see in the data. The second part why this 1 minus alpha probability is trying to capture is the fact that the moment that the planner decides to go to negotiations, well, it takes time to create an offer. You can think the legal aspects and the likes. If the offer is not rejected right away, then we are going to introduce these taste shocks that you want. So there will be evaluation of debt. If it's accepted, that's going to be in a moment QA. Is the one down here, and there will be a value of debt if the debt is if the offer is rejected. We are going to assume that this valuation of how much the actual valuation changes for the sovereign for the creditors is affected by these two shocks, epsilon A and epsilon D. They are going to come from a Gumbel distribution. This is going to give us tractability, resulting in the probability of acceptance given by the expression that you have at the bottom of the screen. Now, with these idiosyncratic shocks, what we are trying to capture is the fact that even when we sit to the table, there are the legal aspects, there might be coordination issues among the creditors, and this might trigger this, that the offer is not accepted with the terms that, with the haircut that was proposed by the planner. Here, just the value of a unit of debt that is accepted is given by this expression. You can see there is a haircut that is going to reduce the amount that has to be repaid today. It takes into account that tomorrow there will be debt. Something that is interesting in this type of model that we have, because there is a haircut, next period there will be less debt that has to be repaid. So there is a debt concentration effect, and that is taken into account by the creditor when he's trying to decide whether to accept an offer or not.
Question. So I guess you have these assumptions on how this renegotiation is set up, but I guess you're gonna focus on the difference between hard and soft defaults, and how and those sort of setup is the same. So can you give us a little bit of intuition of what's gonna look like a hard versus soft default in the context of, I guess, these? So are you gonna do that later? Or?
Yeah, I'm gonna do that later, but I can give you a preview. What is going to happen, and as I tried to explain at the beginning, is that when the sovereign gets hit by these growth shocks, is going to come to the table with a big haircut because I don't have enough resources because my trend declined by a lot. Okay, and with that haircut, then because we have this probability of being rejected, there is a big chance that it's not going to be accepted, and this is going to keep moving over time and getting this endogenous duration of default. So let me give you a quick intuition of how the model operates. So let's have a very simple model, one single good. There is a risk neutrality. Both the planner and the creditor are going to discount the economy at the rate rho. This is a continuous time model. The economy is going to start in default. Okay, and now we want to think how the sovereign is going to make a proposal, a haircut proposal. We are going to assume here that the probability of that proposal being accepted has this structure that you have over there. So you see, if the offer has a very small haircut, then the price of acceptance is a lot higher than the price of default. That increases the probability of that offer being accepted. So if you do the math in this very simple model, one can show that the haircut is given by this expression over here. Now, here you can see two things. First, you can see that the debt to GDP, if I'm having a lot of debt to GDP, either because the stronger real exchange rate depreciation, or because, and this is going back to Christina's question, or because I have this bad growth shock which pushes GDP down. So that's going to force me to propose a big haircut. Okay? You can also see that if the cost of default, this parameter chi, is high, then the planner is going to give you a smaller default, a smaller haircut. Excuse me. Okay. So let me talk briefly about the calibration.
Quick question, if you can, before you get to the calibration. Like in this simplified setup, I'm trying to understand. So there would be delays, like so you assume that alpha is there is an exogenous alpha.
Yeah.
So probably, but without that, would they settle right away?
Yeah. Without that one, is gonna be.
Because like in this model in general, it's hard to generate delays.
Yeah. Yeah. That probability is critical in our setup. Yeah.
Okay.
But you still have differential delays based on the conditions, so it's not. I guess it's the interaction, I would imagine.
Yeah,
so
at the end.
And which condition? I mean, the lender can offer QD, and the other guy would accept it.
No, the lender doesn't offer.
The country, right? The country make a take it or leave it office of QD. The other guy is indifferent. They accept it and they move on, right?
Yeah, that'll be the case. Okay, so let me spend some time talking about the calibration and estimation, because that's the other part where we want to make progress with these models of sovereign default. As you probably know, they are difficult to solve because of the non-linearities, and that limits what one can do in terms of the quantitative or how we discipline these models. Traditionally, the way we do it is via calibration. So here we are going to introduce a twist, and we're going to do a calibration and estimation exercise. Okay. We are going to fix the rate at which debt accumulates during default at a value that is 2% per quarter. In the paper, we explain that this value, given some parameters of the debt maturity and the coupon payments, is going to give us the same rate that the debt in good standing would have repaid following 14 quarters of default. Why 14 quarters? Because that's the average default duration that we get in the Trevethan-Seville data set. So the way the calibration estimation exercise works is that conditional on a set of parameters, the ones that you see there, chi, beta, alpha bar, and sigma bar. We target moments like the duration default, the duration of default, the standard deviation of the duration, the fraction of time that the country is on default. Conditional on that, then we estimate the parameters of the productivity process that you saw. And we try to match the three variables in Argentina as a data. One is GDP, the second one is the real exchange rate, and the third one is the default. We have a default flag that tells us when the country was in and out of default. So this is a fixed point, as you can see, so it takes some time. But at the same time, the advantage of this approach is because we use actual data from Argentina, then I can tell you stories about what happens if I shoot down the transitory shocks or the growth shocks. And this is important because of the quantitative nature of the paper. Okay. So here, what we did is once we estimate the model, we estimated with Argentina data, I want to say. Here, what we have on red is the data from Trevethan-Seville. Okay, so we have on the horizontal axis the duration in years, and on the vertical axis the size of the haircut that was agreed on after the country leaves default. Okay.
Sorry, Pablo, super quick, but I guess also it's still true that you have to believe the structure of the shocks. If I were to do other type of shocks for the other type of processes for what you're trying to estimate, I will get other I'm not following what's the big gain of estimation. I'm trying to say I want to separate the persistent versus transitory. But if I would have volatility shocks or other kind of shocks, that would change everything too. So,
yeah, that's correct. So, so two comments to that. One, that's the beauty of this estimation exercise, because then we can go. I'm not going to talk about. You can go and see the size of the shocks that were affecting the economy, and then we can say, are those reasonable or not? We know that there are more things that can be happening, but at least it's a starting point to think about these shocks and the triggers of why, or the drivers of these hard versus soft defaults.
One more clarifying. So I guess in the data there, you have what you call default and also what you call successful negotiation.
Yeah.
Do you do that as well in the model, or?
No. Okay, so here we have the blue circles. Those are the model's predictions. You can see that the positive correlation is there, but the model is predicting higher haircuts and longer maturities of longer durations of the default episode. This is not surprising because the data set from Trebesh and Sabel is a panel of countries. Argentina is one of them. So we think the model does reasonably well from that point of view. Okay. So now let me spend the last 8 minutes of the presentation to talk about the hard and soft defaults. So we simulate the model many times, and then we see the haircuts that are proposed in the model, and then we do the same classification as Trebesh and Sabel. Okay. And what do we get? Let me start with this panel. So here we have the GDP of these economies that go through the hard default and the soft default. The blue is the dynamics of the average default episode in the economy. The red is GDP after a hard default. Okay, and the blue dotted, the green dotted line is a GDP following a soft default. And you can see that the model replicates that first figure that I show you in the data. Something nice that I didn't appreciate of this model until I was preparing this presentation and I read Christina's paper again, is that they make a point that if you think in terms of the debt to GDP ratio, they mention that you see this hump in the economy, in debt to GDP. It's not only about the hump, but also once you exit a default over here, you end up with more debt to GDP in the economy. Okay? You can also see that the model rationalizes the real exchange rate that you have it over here. You can see that you enter these hard default episodes, the real exchange rates depreciate by quite a lot compared to the green dotted line, which is the real exchange rate under the soft default. Yes?
Well, just about the scale. What is the scale on debt to GDP?
Oh, I think it's on a steady state is 1. That's like 100%. So that's what it means. And that's one of the variables that we target in the calibration of the exercise. So here, what it's going to tell you is that the debt increases by 3 times before compared to the pre-default episode.
Pablo, is this something that, in some sense, so your theory was built to try to explain these things, no? This is not surprising. This is what you wanted to happen, right? In some sense, or okay.
So let me show you now, because we have the growth and transitory shocks. So let me show you again why the negative growth shocks are generating the dynamics of the haircuts, the increase of the debt to GDP ratio. So here what we do is these generalized impulse responses, where at time 0, the economy is hit by one particular type of shock. Let me concentrate again on the green dotted lines. At that point in time 0, there is an adverse growth shock to the economy. Okay? So you can see GDP declines persistently. You are below trend, which is the blue line in more or less the blue line in the figure. What happens? Well, bond prices go down because you're going to propose these haircuts. You cannot repay. Debt to GDP goes up for two reasons. One, because there is the depreciation of the real exchange rate, as you can see on the right lower panel. Okay. So now let me show you, as I said, the model, you can estimate it. So you're going to take the Argentinian data, and we're going to do an estimation. And what you get out of the estimation is the following. The red dashed line is the actual data in Argentina. The blue line is what comes out of the model once we feed the actual shocks that came out of the estimation. And as you can see, the model does a reasonably good, it does well in terms of matching the GDP, the real exchange rate, and the debt to GDP in the data. The size of the haircuts offered in the model is the blue dotted points. The red crosses are what is the haircuts that were agreed on after the Argentina left default in these different episodes. And you can see that also in terms of the spreads that we are not actually targeting in the estimation exercise, the model does something reasonably well. In the last 3 minutes, I'm going to talk about something that is really important when we started this model. We want to think, is it that these hard defaults are the result because of the growth shocks that push me to offer this hard default because I'm really poor, I don't have resources to repay? Or is the fact that the sovereign chooses to be aggressive in the renegotiation process? I don't need to be aggressive, but I'm going to choose to be so. So this is what in the literature is called causation versus selection. Selection refers to the fact that I was selected by a bad shock, so I don't have much resources. I'm going to keep offering these big haircuts. So here, the way we are going to try to capture in the model, we are going to say, okay, so suppose one way of thinking how the sovereign is going to consider this causation effect, the fact that I choose to negotiate, one way to think about how the planner is going to internalize is by this default cost chi. So what we are going to do, we are going to say, okay, so suppose I remove the cost chi from the model, and let me compare that economy versus the economy where everything is working. Okay. And this is what happens. So we are going to, again, we are going to simulate the model. The blue line is the hard default in the economy. The red line is, again, the soft default in the baseline economy. What we do in this case, we are going to have, again, the same exercise, but I shoot down the cost of default. And as you can see, the dynamics of this this counterfactual economy, where there is no causation, if you want, is comparable to the one in the baseline model. So as a result, or coming out of this figure, what we learned from the paper is that these hard defaults are a result of these exogenous disturbances. It is less about the planner being aggressive in going to the negotiation with the creditors. Okay. So let me conclude at this point. I hope that you get out of this presentation that at least from the perspective of our model, having these endogenous fluctuations in the real exchange rates is critical. One, to inflate the amount of debt coming out of these default episodes. Two, this endogeneity of the real exchange rate makes the cost of default more costly, hence resulting in this simple structure of the cost function compared to what the literature has tried. And finally, the planner is going to propose bigger haircuts following these adverse growth shocks, and the creditors understand that and will accept these big haircuts because they know that in the future they are going to keep getting those big haircuts because the economy is still well below trend. Okay, thank you.
Okay, thank you to invite me to discuss this paper. Let me start by saying that these are my views, are not the ones of the Federal Reserve Bank of St. Louis or the Federal Reserve System. And let me continue saying that this is a very hard paper. As you all probably know here, many of you are working on sovereign defaults, and working on sovereign default is very hard because many things are happening in these countries when they go into default and start working on renegotiation of this debt. So I think the authors are doing a terrific job on making progress on these questions. And Pablo did a great job presenting the paper, so let me just go very quickly. I'm gonna show 2 slides about the model to highlight what I think are for me the main ingredients. And then I have three comments for the authors. So what are the endowments preferences in this economy? It's very simple and standard. There are tradables and no tradable goods. The tradable goods have the tradable goods, can I use this? The tradable goods have transitory and permanent shocks, and that's gonna be the key in the model to think about the mechanism through which the sovereign restructuring is going to come in from transitory versus permanent shocks. And then on the households are very standard, hand-to-mouth households that really are going to receive transfer from the government. And so that's going to mean that there's going to be a consumption function that depends on how much tradables you have, how much non-tradables you have, and the transfers you receive. And then default is also very standard. There is a cost of default in terms of the tradable goods, Chi. When you're in default, the government is inactive, there's going to be no transfers. And so you're going to have a consumption function that depends on basically on the amount of tradables that you have in the economy and the non-tradables. What are the value functions? You have 3 states. Here is the novel part. You can be in repayment, negotiation, or default. If you're in repayment, you have to choose how much transfers you're going to send to the households, meaning how much you're going to be borrowing from the sovereign debt markets. And the new part here is that once, next period, you're going to choose between repay or negotiate. So what does it mean to negotiate is that you're going to be, if you decide to negotiate, you're going to make an offer, a haircut H, that's going to bring down the level of debt. And if this haircut is accepted with a probability, that's going to happen if the haircut is accepted with a given probability A. And if it's rejected, you're going to be going to default. So basically, we were asking about the timing before. You are today in repayment. Next period, you can decide to negotiate. And if this is accepted, you go back to renegotiation, where if it's rejected, you go to default. And this probability of acceptance is basically, there is a fundamental component that is the price that the lenders are going to receive if it's accepted with a given haircut, or the market in the secondary market when this is going through default. And some preference shocks, as well as some alpha bar probability to make the duration longer. And then default is a standard. You're just waiting there, and every period you're going to be going through the next renegotiation until eventually go back to repayment. So that's it. That's the model with let me highlight. There are two important things in the model: the permanent versus transitory shocks, and this renegotiation stage. And the paper is trying to think about the relationship between these 2 new ingredients into this otherwise standard model. So what do they see in the data? That these harder defaults, those with larger haircuts, are associated with larger decline in output, longer default durations, as well as larger real exchange rate depreciations. And what maybe the paper is changing a bit between the presentation today and what is written in the draft, but the way the paper was written, the main economic question is how much of these effects are due to the selection versus the causal effects. And those were the last 5 minutes of the presentation. So what is the selection? The selection is that due to these exogenous shocks that can be either transitory or permanent, they can cause both harder defaults, larger GDP declines, and larger real exchange rate depreciations. And that's going to be the main the selection mechanisms. On the other hand, what's going to be the causal effect is that these harder defaults cause large GDP declines. And my first comment is going to be related to what's the role of the causal effect in this economic framework. But so what the author found, what is the main mechanism, the selection mechanisms? Again, you have transitory and permanent shocks. You have these permanent growth shocks are going to cause debt to GDP to increase and remain high for long times, which is going to imply in the model to larger haircuts. On the other hand, if you have a transitory shock, this is going to cause both a smaller and less persistent increase in the debt to GDP ratios, which is going to result in smaller haircuts. When they put this into this model, this main mechanism explains most of the selection in the data. The model generates about between 60 and 85% of the data. It's coming through selection. And that's the main quantitative result to me. What is left over is going to be coming from the causal mechanism. So what is the causal mechanism in the model? It is that this causal effect in the models come from, really, is the cost of being in default. It's this sky that if you go through default, you have less tradables. That's what the authors are calling the causal effect. And that's going to just, by construction, explain the remaining 15 to 40% of the data. So here is my first question. If this is really a paper to think about selection versus the causal effect, do we have a good model to think about and to identify the causal effect in the data? And really, if you look at the economic framework, the causal effect is all about the duration of the default. In particular, in this model, conditional on being in default in a given period tau, the causal effect is going to be 0. It's all coming from this, what they call the selection. And this is really coming because it's an endowment economy. So the only way in which GDP is going to be endogenous, if you want to call it, is due to this exogenous cost of default chi. In other words, this model does not have a way in which haircuts are not going to be able to affect GDP. So maybe if you want to go really after this question of how much is coming from selection versus how much is coming from the causal effect, I don't see other way that just going to a production economy and having an endogenous production economy. That's something I'm going to show you in a few slides. But let me be a bit more positive about the paper because I think it's a really nice paper. So what I'm going to propose is, what is this paper doing to me is it's not really how much is selection versus how much is causal, but it's really proposing the selection mechanism. They have the model. They say, okay, we think that it's coming through this selection, which is coming from permanent versus transitory shocks. And so now the authors can go one step further and test this mechanism in the data. In particular, the model is saying to us that these growth shocks cause large haircuts, where transitory shocks cause small haircuts. This is something that we can test in the data, and that's something I'm going to try to do in the next 2 minutes. So basically, in particular, because we are thinking about Argentina, I guess all of you know the 2001 default in Argentina, and about half of you know about the default in '82. So let me show some data about what's happened in Argentina in this period. So this is a figure of real GDP in Argentina starting in the 60s. So for those that don't know, in 1982 was the end of the dictatorship period. We went to the war in Malvinas, and we made a sovereign default. And what you see here in the figure is that we have, this is data from the same database that the authors are using. We have 3 attempts of renegotiation, which are going to be what they're called the soft haircuts. They are below 35%, the 40% that he was saying to Cristina. And then you have the default 2001 with a large hard haircut of over 75%. What's happening in Argentina? In the first default, if you compute what's happening with GDP, dropped by 32%, and if you put them together, it took over 10 years. If you look on the other hand, the hard default, the drop in GDP was smaller, 26%, and much shorter. In 2005, we went out of renegotiation. So the stylized fact, the mechanism that the paper is trying to highlight is this hard default are associated with large decline and longer duration. But if you look in Argentina, it seems to be to be the opposite. So if you want to use Argentina as a case study, this does not seem to align but I still think there is a solution to this. Because if you look together, the renegotiation in 85, 87 plus 93 really was really in 93 when you get out of the default. If you put them together, the total haircut is 63. So maybe after all, it's not that these are soft haircuts, but really, if you look them together, maybe they are hard. It's a hard default at the end. So my proposal is to really go to the data, do what Federico was doing in the past, looking really detail by detail on each sovereign restructuring, and you have less than 200 cases. So go to these cases, study, think which ones are really which ones are hard and soft, and see if you have data. And I'm running out of time, but this is just to say that you really think, according to what Tim and Juanpa and Tom was saying, if you want to think about these economies, they really have to think about the production economy with where the policies, domestic policy, fiscal and monetary policies are really are going to be changing and important for these countries. And here we propose a framework that can be used to think about this, the causal effect, if you want. So let me stop here. There is more stuff that we can talk offline. Thank you.
So Pablo, do you want to maybe reply to Julian and then we'll collect some questions?
Oh, thank you, Julian. That was an amazing discussion. I really like it. Actually, I'm going to borrow some of your slides for future presentations. They are much better than mine. Thank you on that. Actually, I agree on your point on the production structure. That's like the way we think about causal defaults is not satisfactory. Now we are working on a model with a labor component. We hope that's going to go in the line of what you are pushing to us to think more deeply about actual causal effects in the economy that makes a distinction relative to the selection channel that we have. Also, thank you, the way you think about the sovereign defaults in Argentina, the 80s versus the 2000s. I agree that it's going against our story, and we'll have to rethink how we want to, again, we are facing this challenge that on one hand, Argentina has been studied in many different papers, by Andy, for example, and we know a lot about the country. We have the data, so that's the natural point to start. But at the same time, your suggestion that if we go to the micro data, if you want, from Trevesh and Sabel, then we can handpick those countries that fit our narrative, and then do the estimation exercise, with the caveat that then comparing to the existing literature is going to be is going to be limited compared to that. But I agree.
Okay, so any questions? Yeah.
Okay. Sì. Yeah, so it seems, at least from the presentation, that mostly the focus is on there are those shocks, and then there is the issue whether to renegotiate default and so on. But what are the implications for the what happens before? So in other words, leading to borrowing. Perhaps one way to think is that there are good growth shocks, whether they are actual growth shock or anticipated or beliefs of growth shock that might lead to this big increase in debt. And then when perhaps it's the reversal of that prediction that might generate those big decline. So, for instance, what is the importance of the debt once those defaults basically happens? And I was thinking whether the distinction between temporary versus growth shock in some sense is a little bit the distinction between a small shock versus large shock real. Because in some sense, the growth shock is like the anticipation that when you accumulate the decline in productivity, actually, a growth shock is very big.
Yeah, thank you. That's an excellent question, comment. I don't think we thought about this the pre-default run up on debt, because as you said, I was lucky I got all of these good shocks, so it's easier for me to sustain more debt because it's the debt to GDP is either stable or not growing as fast as GDP. And yeah, that's we can do it in the model and see how much these good shocks can predict the hard default. That's a cool exercise that we can do it. Roberto?
Yes, very interesting presentation and discussion. But when you started talking about the data and so on, I thought, okay, this is going to be a paper about marrying the sovereign debt literature with another literature that you did not mention in your slides, which was the literature on financial frictions, balance sheet effects, and the impact of real depreciations on that, right? I mean, and that would be actually quite useful on the one hand for policy purposes. It is actually very consistent with cases that we've seen in practice. And it, for example, would allow you to endogenize some aspects of your model that are quite ad hoc, like, the cost of default. I mean, when you have, the mechanisms that, for example, Céspedes, Velasco, and I have worked on, right, a default that would trigger a big devaluation would itself also, like, essentially kill the financial system, and that would impose a large cost on the economy on top of the sovereign default costs as well. So that actually would go very much in the direction of the model that you're trying to develop, except that some of these effects would be actually both endogenous and in fact much more credible in the sense of the narrative.
Thank you, Roberto. Sorry, I didn't mention. You're not only that paper, but also the one that you have with Andres Fernandez, where you have the financial frictions, and you think again about these issues that Martin Uribe and also Mark and Gita were discussing about growth versus transitory shocks, financial frictions. But yeah, related to your previous papers, that's something that didn't fly in my radar. So now I have to go back and read them again and think how we can bring that to these models of default.
Okay, so thank you very much for all the questions and comments. We can continue discussing over the break. So we'll be back at 11:30. Thank you.
Matias Moretti talking about inelastic demand meets optimal supply of risky sovereign bonds. Matias.
Okay, thank you very much for the invitation. I'm really happy to present this paper today. So this is John Ward with Sergio, who is in the audience, and also with Tomas Williams, Lorenzo Pandolfi, and Germán Villegas, who is at the IMF. Because Sergio is at the World Bank, Germán is at the IMF, the usual disclaimer applies. So let me start with the motivation of what we're going to do in this paper. And just, to illustrate things, let me start with a very simple observations that governments in emerging economies depend heavily on bonds that are issued in international markets for their financing. So understanding the behavior of these international investors is going to be crucial to try to understand what are the borrowing costs of the government and how it's going to that affect and shapes the debt policies or the default risk of these countries. So what we do in this paper is to ask ourselves two related questions. So the first one is how inelastic is the demand for risky sovereign bonds? And there is a growing evidence and a lot of recent papers that estimate demand elasticities across different markets. Most of those studies, which are the ones that we cite here, are for safe assets, mostly for the US, some for Europe, and for equities. Now, we're going to expand on those papers by analyzing the demand elasticity in a specific market, which is the market for risky sovereign bonds, meaning bonds that are issued by emerging economies, by governments in emerging economies. Now, in the second part of this presentation, what we're going to do is to analyze what are the implications, the macro implications of facing a downward sloping demand. So, for example, what are the effects on government borrowing cost, and also how that elasticity or inelasticity of the demand affect the optimal supply of these bonds. So what we're going to do in this paper, in the first part, I'm going to provide new evidence of downward sloping demand curves in these sovereign bond markets. We're going to be analyzing the bonds that are issued by emerging economies in dollars in international markets. And we're going to estimate bond price reactions around monthly changes in the composition of the largest benchmark index for emerging economies. So the idea behind all of this, and I'm going to be explicit about what we're doing in the empirical analysis, is that changes in the composition of this benchmark index is going to affect the demand of passive investors that are trying to replicate the composition of that index. So whenever there is a change in the weight of the index, these passive investors are going to adjust their demand. That's going to create a shift in what we're calling the available supply of bonds to active investors, and we can use that shift in order to estimate a demand elasticity for these assets. Now, in the second part of the presentation, we try to quantify what are the aggregate implications of facing this inelastic demand. And for that, we build a quantitative sovereign model in the lines of what Pablo just presented. And we're going to introduce an elastic demand. We're going to do this following Gabeck's code, and it's going to be very simple. What is important is how we're going to discipline that demand. We're going to be basically estimating that demand through our empirical estimates. And for that, we're going to need some new features in these standard sovereign debt models. For example, we're going to introduce a passive demand. I'm going to explain that in details, and also secondary markets so that we can replicate within our model these high frequency estimates that we have in our empirical analysis. So just as a preview of the results, we estimate an inverse price demand elasticity of 0.3, which is a little bit higher than other estimates for advanced economies. So for safe assets, for the US, there are a couple of papers that document an elasticity of 0.1, for example. But more importantly, what we show is that this elasticity increases with default risk. So we argue that this at least is suggesting that investors are demanding a premium as a compensation for holding these risky bonds. And we're going to be calling that as an inconvenience yield. Now, in terms of the quantitative analysis of this paper, we show that about a third of this reduced form elasticity that we estimate from the data is not directly capturing a downward sloping demand itself, but it's also capturing some future endogenous changes in bond payoffs. And more importantly, we analyze what are the macro implications of this elasticity. And what we show is that, if you face a downward sloping demand, you need to internalize that if you issue one additional unit of debt, then the price of the bond is going to decrease, not just because of default risk, but also because the lenders want to pay a lower price. The governments in our model are going to internalize this effect, and I'm going to show you that this is going to create, in a sense, a commitment device that is going to limit debt issuances, but ex ante is going to reduce default risk and the borrowing cost for the government. So let me jump directly to the empirical analysis of the paper. So as I said before, we're going to be using index rebalancing as passive demand shocks, and we're going to use these changes in the passive demand to estimate our price demand elasticity. So the idea, consider any asset I that is part of a benchmark index. So you can always decompose, obviously, the demand of that asset into an active and a passive demand. And for us, a passive demand is going to be, we understand as a passive demand, the investors' holding that are aimed at replicating the composition of that index that they're following. So then you can just write this market clearing condition as follows. So on the left, you have the supply of that asset B. On the right-hand side, we are just decomposing the demand into an active component and a passive component. So the active demand, it could be a function of many things. So it could be a function of the excess returns of the asset, the volatility, some liquidity properties. Now, what is important is that the passive demand is going to be a function of the weight of that asset I in the index that these passive funds or passive investors are tracking. So changes in those weights, in those Ws, are going to create a shift in that passive demand. And the idea is that passive demand is perfectly inelastic because these guys are just replicating the composition of that index.
Clarifying question.
Yes.
So the index, I'm not so familiar. So the index is being, the weights of the index are changing over time. What is the example of the index?
Yes, I'm going to show you the details about that, but the idea is that every month, the weights of that index are going to be changing. There are some, some rules that JP Morgan follows in order to change that composition. So at the end of each month, the weights are going to change. These passive funds are going to rebalance their portfolios, and that's the sort of instrument that we use in order to estimate this demand.
But doesn't the demand of the index also change? If there is an index full of Mexico and Mexico goes crazy, the demand for the index will fall.
Yes, and I'm going to be more explicit how we're going to try to isolate that sort of variation. I'm going to explain that in details in the identification part of the paper. Okay, so this is kind of like the idea of what we're doing here. So let's trust me for a second that we can identify some exogenous increase in the passive demand, okay? And the idea is that if the passive demand increases, what is going to be happening is that the effective supply, or meaning the bonds that are available to active investors, is going to decrease. Okay, so you have a decrease in the effective supply, and if the demand is downward sloping, if the active demand is downward sloping, then there should be some price effect, okay? And we can try to estimate that price effect in order to back out a demand elasticity. That is, of course, assuming that the expected payoff of the asset are completely unaffected by the change in the passive demand or by this shift in the effective supply. Now, you can also argue that the fact that the passive demand is changing, and the fact that you observe a higher price, it may have an effect on the expected payoff of the asset, which is the case that you have on the right of my slide. So here is a case in which after this shift in the effective supply, there is a higher expected payoff for the assets, and that implies that the active demand is going to shift up. So if you just estimate a reduced form elasticity, you're basically going to be creating the bias, because part of the price reaction is not going to be captured by the downward sloping component of the demand, but it's also going to be reflecting some endogenous change in the future payoff of the asset. Okay, so for that we need a model. I'm going to show you that an important part of our reduced form elasticity can be explained by that type of mechanism. Okay, so now let me jump directly to the empirical analysis. So what we're going to do here is to construct well-identified shocks that are going to shift the effective supply, and we're going to measure high frequency, meaning daily, price reactions to the shocks. So in order to do this, we are exploiting monthly rebalancings in the JP Morgan MB Global Diversified Index. So we have data for 2016, 2018, We have about 36 rebalancing events, okay? Our data covers almost 70 emerging countries, and we have data for about 700 sovereign bonds and more than 100,000 daily bond observations. So the first thing we're going to do is to define this notion of fair or flows implied by this index rebalancing. So it's just, the change in the passive demand, that is the delta T, scaled by the active demand behind these bonds. And we're going to do this at the country level, okay? So C here denotes the country. So how can we measure that change in the passive demand? Well, in our case, it's just going to be given by the change in the index weight, okay? So the delta W, W is the weight of this country C in this MB index. And we are going to scale that by all the asset under management of all those funds that are passively tracking the composition of this MB index. Now, this goes back to Andy's point. There is this concern that this fair measure is obviously endogenous, okay? And it's going to be capturing changes in weights that are driven by a country's own fundamentals. So, for example, the fact that Mexico, for instance, issued at some point a lot of bonds, so the weight of Mexico in the index is going to go up. It could also be capturing some redemptions, or more broadly, just changes in bond prices, which are endogenous and reflecting the fundamentals of these economies. So how we're going to tackle this sort of concern? This is what we're going to do. So first of all, we're going to basically exclude from our analysis all those countries for which in a given month they have a new issuance or a redemption or a repurchase. So in our case, we're going to be looking only at countries for which the stock of debt in a given month is fixed. So BCT equals the stock of debt in the previous month. So that's the easy part. Now the hardest part is, okay, but how can you exclude variation that is coming just from prices, okay? So for that, we're going to be exploiting a particular weighting scheme of this MB Global Diversified Index. And in particular, it's essentially a cap rule that, unlike other market cap indices, this MBGD is going to restrict the weights of countries with an above average bonds outstanding. Okay, so the weight in the MB index, the W, is not just a function of the market value of those bonds of country C, but it's going to be, affected by that FCT, which is what they call as the diversification coefficient or diversification ratio. And the idea that FCT is going to be, a value between 0 and 1, and it's going to be something that is smaller than 1 for countries for which the face value of their debt, so BCT, is higher than the index country average, okay? So the idea is that there's going to be a limit to the quantity of these bonds that are going to be included in the, to compute the weights in this MB index. So obviously, you can observe the prices. The Q here is the price, so the weight itself is a function of the price. So what we're going to be doing is to define what we call a synthetic weight that is only based on the diversified face amount of those bonds. Okay, so the same weight as before, but we're basically excluding the prices. So this is just going to be a function of the quantity of bonds that are included in the index, and that is going to be affected by that diversification coefficient FCT. So we're going to define this ZT as the relative change in those weights, theoretical weights, and that's what we're going to be using basically as an instrument to our fair measure in order to isolate any variation that is going to be coming from prices. So now let me be clear about what is going to be the rule of this, or what is going to be the effect of this cap rule. So what is going to be the effect of that F of CT? And the idea is that if you have an issuance or redemption that is made by a country other than country C, that obviously is going to affect the denominator in my equation right there. But it's also going to affect, at least for some countries, it's going to have an effect on the FCT because the average of the face value of the bonds in the index is going to be changing after you have an issuance or redemption from this country. So the FCT is going to change, and that effect by itself is going to be heterogeneous across the countries that are included in the index. So what we can do is, in a nutshell, to exploit variation that is coming from this specific cap rule. So basically, we can analyze that variation within an event. Now, if you don't have this cap rule, so in the absence of this diversified face amount, you still have variation across events, so across every single monthly rebalancing event. So we can also obviously exploit that sort of variation, but the fact that you have this cap rule imposed in the index itself, it's a little bit stronger because it allows us to exploit variation even within an event through these changes in the F of CT. So let me just provide a graphical illustration of what is happening here. So in this graph, what you have on the x-axis is the country face amount, so that is the B. On the y-axis, you have the diversified face amount, so the B times the F. So if you are below the ECA, which is the average of the face value of all the bonds that are included in the index, then you are not capped, so it means that the F is equal to 1. But if you are a big country, let's say China, for example, the cap is going to be tight. So basically, the F is going to be smaller than 1. And you can see that the diversified face amount is going to be smaller than the face amount for that country. Now, if you have issuances that are coming from other countries, this vertical line, this ECA, is going to change. Okay, it can increase or decrease depending on whether those issuances are higher or smaller than the average of the index. So basically, changes in that ECA is going to create a change in the FC, or the diversification coefficient of the countries that are capped. Okay, and that is the sort of variation that we can exploit in order to compute these demand elasticities. Okay, so this is our main regression. So remember that we have these monthly rebalancings. We're going to be calling that an event. And as I said before, we can exploit two sources of variation. So the first one is just across time or events. So basically, we can compute changes in bond prices just before and after each of these rebalancing events. So for that, we're creating asymmetric 5-day windows around each of these announcements, which happen always the last business days for each month. Okay, so this is kind of the regression that we're going to be considering there. On the left-hand side, we have the daily bond price in logs, so that is Q. We're going to be doing this at the bond level. Okay, so we have a bunch of bond month fixed effects to capture any variation that is operating at a lower frequency or at the month frequency. And then our variable of interest is that beta, which is capturing the effect of changes in this FLAR instrumented through these changes in the diversified face amount, times a dummy variable that is going to be 1 only for the 5 days after this rebalancing. Okay, so that's kind of like an event study. But then, because of the cap rule, we can go one extra step, and we can exploit variation within an event. So for that, it's going to be pretty much the same regression as before, but now we introduce that post-month fixed effect. So basically, now we have a fixed effect for the rebalancing event itself. So the aggregate effect of the rebalancing is going to be captured in that fixed effect. And now the beta is going to tell you basically, it's going to be telling you or exploiting the cross-sectional variation across countries within an event. So let me just jump to the results. So we have many specifications. As you can see, we have much more in the appendix. If you focus on the column that is highlighted here in gray, that is exploiting variation across events. So that is kind of our event study. And as you can see that the beta here is about 0.2. Now, if you exploit variation within an event across countries, the beta is a little bit higher, a little bit more noisy also, but higher. So in the ballpark of 0.3. Now, one concern is that, well, these events may be expected, okay? So the active investors or even the passive investors can be operating even before the announcement made by JP Morgan. So you could expect that these price reactions are actually observed before the rebalancing day itself. So for that, we consider a similar regression to the one that I showed you before, but to analyze the effect across time. So here, in the x-axis, whenever you observe the +1, is the rebalancing day, is the day of the announcement. So before that, you can see that the estimates are close to 0, meaning that there is no anticipation except the day before of the rebalancing. Okay, so the day before, we do observe a slight anticipation. So some of these funds anticipate that the JP Morgan is going to announce the new index, and they are trying to make a profit out of it. Okay, and that is consistent with previous work from Tomás and Lorenzo, who also showed that sort of anticipation effect in another context. Okay, but the key idea here is that before the rebalancing event, we do not observe a clear pre-trend. Okay, so to summarize this discussion, what I showed you before in the table is that if you have a 1 percentage point increase in this FLAR measure that we constructed, that is going to lead to a 30 basis point increase in bond prices. And obviously, because of how we constructed that FLAR that is normalized by the active demand, we can just directly map those estimates into what we call a reduced form elasticity. And that estimate implies an inverse demand elasticity of 0.3, which, as I mentioned before, is higher than estimate for other developed economies, but it's comparable, for example, for estimates for US corporate, and it's significantly smaller compared to estimates for the equity market in the US. Now, as I said also during my introduction, what is important is that these effects that I showed you before are heterogeneous across countries. And what we find is that inverse elasticity is actually higher for countries with a high default risk. So if you take countries whose default risk is above average, what we find is that a 1 percentage point increase in the FLAR results in a 41 basis point increase in bond prices. If you look at safer countries or countries with a default risk that is just below the average, the estimates are significantly smaller, 11 basis point increase. They are actually not significant, but these estimates are more or less in line with other estimates for the US and also for Europe. So we take all of this as evidence that these investors, they're demanding a premium as a compensation for holding those risky assets. And as I said before, we're going to call this an inconvenience yield. Okay, so in the 15 minutes that I have left, I'm going to introduce now a structural model to try to analyze what are the implications of facing an inelastic demand. Okay, so let me jump directly to the model. It's going to be kind of like a standard model. So we have a structural sovereign model with endogenous default. It's going to be an endowment economy in which output is stochastic. The government issues long-term debt in international markets, so all the debt here is going to be external, just to smooth the consumption of the representative household. The government has limited commitments, so it can default on its debt, and the standard assumption is that if the government is in default, it's going to be excluded from debt markets, and it's going to suffer some output losses. Now, on top of this very standard framework, we're going to be introducing inelastic investors. And what is important is we're going to be able to discipline that investor's elasticity based on the empirical estimates that I showed you before. But we want to take this seriously, and we want to measure the same elasticity in the model that we did in the data. So for that, we're going to introduce a passive demand and also changes in some index. And in order to capture this notion of high frequency that we exploited in the data, we're going to introduce in the model secondary markets. So with all those ingredients, we will be able to replicate the exact same elasticity that I showed you before. And then we're going to use the model to decompose the elements behind that elasticity. So let me just give you a summary of, or the setup of the model. So as a standard, a benevolent government that issues long-term debt to maximize that function that you have there. The government has limited commitment, so it can default. Now, this is going to be the resource constraint in the economy. This is the model with long-term debt, so consumption is going to be just the sum of output plus the proceeds from issuing new bonds. So lambda here, or 1 over lambda, is capturing the maturity of those bonds. Q, as before, that is the price, which is endogenous in the model. And then on the last part, you have whatever you have to pay today in terms of debt services. So part of the debt is maturing, that is lambda, and also you have to pay some coupons new. And then if the government is currently in default, it's going to be excluded from these international debt markets, and it's going to be subject to an exogenous output cost. Okay, so now let me introduce the inelastic investors within this very standard framework. So for this, we're going to be following the Gabay-Cohen sort of approach. So let me assume that there is a continuum, or a large number of investors in the model. So J is going to denote each of those investors. And the assumption is that they are going to have a mandate that is going to tell them how they should allocate their resources or their funds across n risky assets. Okay? And you will see that by doing this, we're going to be able to create an inelastic demand. And on top of that, we're going to introduce a passive demand, as I said before, to create this very tight link between the model and the data. So I want you to think that there are some passive investors that are tracking the composition of some benchmark index. So going back to Gabay-Cohen, what they assume is that each of these investors, they're going to allocate a share X of their wealth W to an asset, okay? And that share is going to be completely exogenous or reduced form, and it's going to be a function of some elasticity that is going to be captured by the lambda J, and a function of what they think is going to be the expected return of the asset. So this is just following Gabay-Cohen, but we're also allowing for the possibility that some of these investors are fully passive. So apart from the active component, which is the one that you will find in that paper, we introduce also this passive component. So a fraction theta J of these investors are going to be passive, and what they just care is to allocate the resources just to replicate the composition of the index that they're following. Okay, so as I started the paper, we can now decompose this demand for any bond I in an active component or an active demand and a passive demand. And the idea is that what is important is that the passive demand is just going to be a function of the weights of that asset or that bond in the index. So here, the active demand is this A tilde. The tildes are for just to denote the market value. So that is basically the face value times the price. As I said before, this is going to be a reduced form specification for us, but it's going to depend on some fixed share, the size terms. That is more or less the average amount that these active investors allocate towards bond I. But then they can deviate from that average, okay? And that deviation is going to be pinned down by this lambda J parameter and this phi hat function. The phi hat is going to be capturing the excess return of the bond. So the idea is that if the bond has a higher expected excess return, then you're going to allocate a higher fraction of your wealth to that asset. How much? Well, it depends on the lambda, and that's why the lambda is going to be capturing this inelasticity. Okay, so now to get a close form.
A clarifying question. So the investors lose money in default, or how does, maybe I missed it.
Okay, so whenever you're in default, we're going to be assuming that the passive demand is going to be 0. And that's the only assumption that we really need.
I guess they're going to break even with their passive demands too, or no? In terms of, sometimes there's default risk associated with it.
Yes, probably it's going to be clear when I show you the pricing equation. I think it's going to be clear in that part. Okay, so the idea is that we want to get a closed form solution for the bond price. Okay, so for that, we're going to assume that pi function, it's going to be essentially a function of the Sharpe ratio. So it's going to be the expected excess return of that bond divided by the volatility or the expected volatility of that particular asset. So you are going to allocate a higher fraction of your wealth to bonds with a higher Sharpe ratio. How much? It depends on the lambda. So under that structure, then
so
we...
Matthias, can I go, sorry, quick question. So these bonds are risky in a special sense, right? Also because once you default, the price goes to zero, stuff like that.
It goes to zero because there is no recovery value, yes.
So are these nonlinearities something like that we should think about instead of like a model where actually things are kind of more smooth and maybe volatility is the right measure for risk? You see what I'm saying? I mean, like, if something is very nonlinear, I wonder whether volatility, like, as you're approaching this, is becoming very nonlinear.
I agree. And also, these are long-term bonds. So part of the volatility is going to be captured by the fact that tomorrow the government may default or not, but also part is going to be capturing through the continuation value of the bond, even if absent a default, just because the next period price is going to be stochastic and changing across time. Okay, so this is going to be our pricing equation. So we can decompose the bond price Q in what we call a perfectly elastic price. So that is just the expected repayment tomorrow for this asset discounted at the risk-free rate, RF. But that is going to be now multiplied by this wedge, that psi function, which is capturing this inelastic component. And under these assumptions that we impose in the model, that psi is going to be given by that particular equation, which is, again, a function here of the inverse of the Sharpe ratio, and that kappa function that you can see over there, which is essentially, at the end of the day, a function of the lambdas, okay? So that kappa is going to be capturing, at least in a reduced form way, the elasticity of these assets or the slope of this demand. So we're going to be focusing on a recursive Markov equilibrium. So for this, we need to make further assumptions. So what we're going to assume now is that the passive demand is going to be given by this specific equation that you have there. So the idea is that the passive demand today is going to be basically proportional to the stock of debt that the government has. And this proportion, tau, is going to be exogenous and follows a Markov process. And we're going to discipline this tau process based on our FLAR measure. Okay, so in terms of the model itself, this is a standard the government is going to choose today or at the beginning of every period whether to default or not. If the government repays, then it has to choose the optimal stock of debt, B prime, to maximize the utility of current consumption plus the expected continuation value, subject to the resource constraint that I showed you before. If the government is in default, then it's going to be excluded from international debt markets, but tomorrow there is some probability theta that the government will regain access to these international markets and it will no longer be subject to the output cost. And also here is an important assumption that because the passive demand is proportional to the stock of debt, and because there is no recovery value, the assumption is that whenever you are in a default, the passive demand essentially is going to be zero. So this is going to be the repayment function. For us, this is going to be a standard. So it's going to depend on your default policy tomorrow times what is going to be the payoff that you get if the government does not default. So it's going to be 1 minus the default policy times whatever you get tomorrow if the government does not default. So you get the bonds that are maturing, and also you get the coupon and the next period price of that asset. So with all of this, we can re-express the bond price in a recursive fashion. So it's going to be obviously similar to the one that I showed you before, but again, it's going to be the product of this perfectly elastic price times the inelastic component that I computed before. Okay, so to link all of this with our empirical analysis, and let me be brief here, we need to introduce some notion of high-frequency trades. And for that, we're going to allow for secondary markets within this model. So the model in itself, it's the same as the one that I showed you before, but the idea is that within each period, there are going to be 2 instances in which the lenders can trade their bonds. So they're going to be able to trade the bonds just before the realization of the tau prime. So just before the announcement of these index weights. So that is the QSM0. But then they're going to be able to trade once again within the same period, but after the announcement of the new index weight. Okay, so the price is going to be updated based on that information. Okay, so we can basically replicate the change in the bond price that is coming from the information transmitted through that update of the tau, and that in a sense is pretty much replicating the same as what we did in the empirical analysis.
Matthias, sorry, super quick here.
Yes.
What I didn't follow is I need to understand as a government the passive part also, no? Because and where is that in the States? Either I or something. I didn't.
Yes, the tau is going to be part of your state.
But and tau is that has the whole encodes all the information about.
Yes, here for simplicity, we're assuming that the tau is completely exogenous. So you could argue that
that's fine. Okay.
The tau could be reflecting the way that you have, and you can.
Perfect. Okay.
Okay. Okay. Let me try to explain what we're going to be doing here. So the idea is to replicate within the model the same reduced form elasticity. So we're going to be looking at these changes in prices within a single period before and after the new tau prime is realized. Okay, so we have this shift in the passive demand coming from this update, and then we can compute the same reduced form elasticity as you can see there. That is pretty much what we did in our empirical analysis. But we can do more. Now we can use the model to decompose the drivers behind that reduced form elasticity. So what we argue is that, well, part of that, and what we show is that part of that is capturing a downward sloping demand, but also part is capturing changes in the payoff of the assets that you're going to observe in the future. Why? Well, because the shocks are persistent, because the government is going to react to those shocks. So the expected function of the repayment function itself is going to change, and that is going to be reflected in our reduced form elasticity. Okay? So this is by itself is a broader contribution that goes up beyond the sovereign debt literature. Okay? You can apply the same framework for corporate debt and also for equities. Okay, so let me go over the results in the 3 more minutes that I have left. So we're going to calibrate the model to Argentina. The tau, we're pinning down all those parameters based on our FLAR measure. So the persistence and the volatility is going to be given by our FLAR. And then the key thing is that we have this pricing equation, the one that I showed you before. We have this kappa parameter that is going to be disciplining the elasticity of the active demand. So we calibrate that kappa 0 in order to match our reduced form elasticity. And here you have the decomposition. So in this graph, what you have in blue is the structural elasticity, in orange is the reduced form elasticity. And as you can see, the two are not the same, obviously. The difference is coming from changes in the expected repayment of these bonds that are going to be operating through the continuation value of the asset itself. Okay, so the bottom line is that it is important to consider this difference between the reduced form elasticity that you estimate from the data, the structural elasticity that we can replicate or compute within our model in order to have a proper estimates of these elasticities absent any bias that is coming from changes in expected repayment. Okay, that bias is going to be a function of how persistent are the shocks. We have a bunch of analysis for that. Let me skip this. In the minute that I have left, let me talk for a second about what are the macro implications of all of this. Okay, so what happens when you face an inelastic demand? So what we find, and this was surprising for us, is that if you are facing an inelastic demand, you're going to face lower bond spreads, a lower default frequency, even though you have a higher debt to output ratio. Okay, and the difference, as you can see from the table, are significant. Okay, so why is that the case? And I think that we conclude with this figure. So what you have here is in blue you have some policy functions and prices in our baseline model with inelastic investors. In orange you have the perfectly elastic case. So as you can see, the bond price is actually higher under inelastic investors for low levels of debt, okay? That is not explained by a convenience yield because that size is always smaller than 1. So if anything, under inelastic investors, these guys demand an inconvenience yield, which lowers the price. So the inconvenience yield is not going to be able to explain the higher bond price under inelastic investors. What is happening here is that the fact that the slope of this bond pricing kernel increases as the government issues more and more of these bonds is going to create incentives for the government to stop issuing those bonds. Okay, so in a sense, it's going to be acting as a commitment device. The government does not want to issue a lot because it knows that it faces a downward slope in demand, and for every single unit that you issue more, the price is going to reduce or decrease, not only because of default risk, but also because lenders, they don't want to buy that assets and they demand a higher inconvenience yield. So as you can see, everything here is coming from a change in default risk under inelastic investors. Default risk is significantly smaller. And this has implications for the bond policy. So there is a compression in the distribution of debt to GDP. And what we show in the paper is that the usual procyclicality that you observe for the debt policy in this model is significantly dampened in the presence of these inelastic investors. So you don't want to deviate much from some average or fixed debt to output ratio. Okay, I'm out of time, so I'm going to conclude here. So we presented new evidence of downward sloping demand curves in the market for sovereign debt market. And then we analyzed the macro implications of facing an inelastic demand. And what we find is that an inelastic demand basically creates a disciplining or commitment device that limits debt and significantly decreases default risk.
Thank you very much. The discussant, Yen Bai.
Okay, so thank you for the organizers for inviting me to discuss this paper. I really enjoy reading it. So I'm looking for my slides. Okay. I will start with just putting the paper in the context. Okay, maybe you can go next slide. Where is it? Yes. Oh, yeah, there we go. Yes. So I want to put this paper in the context. Okay, so I want to say, what is the lenders in the sovereign default literature? So most of the literature, we're going to assume that the lenders are just risk neutral. Okay, they're facing exogenous international interest rate. It can be stochastic, but it just doesn't depend on the country's own output, doesn't depend on the country's how much the country wants to borrow. Okay, and then there's also extensive literature assuming that the lenders are risk averse. So in this case, there will be a time-varying risk premium. And then the way we do it is we assume that the stochastic discount factor of the lender correlates with the emerging markets output. Okay, so we have, Christina has a paper like that, Mark has a handbook chapter, and Pablo has his paper with the global banks. And I guess many of you has this paper like that. Okay, so that's another way of modeling the lenders. And there's also the way of modeling lenders, assuming that there's inelastic lender demand. Okay? So I'm borrowing Matthias's language over here. So mechanically means that the borrowing rates depends on the sovereigns, how much the sovereign borrows, even absent from sovereign default risks. Okay? Just give you two examples. One paper, what I have with Christina and Sandra is, we assume that there are two sovereign countries borrow from one lender, and the lender's wealth will be endogenous. Because if one of the country defaults, that generates a decline in the wealth of the lender, and the lender going to charge a higher interest rate. So there we're going to have both endogenous risk premium and also inelastic demand. Another example is by Chamont. In his joint market paper, he assumes that the secondary market trading frictions will affect the demand of these sovereign bonds. So what is the challenge? The challenge is how we're going to discipline this lender's demand curve. So in my paper with Christina, we assume we actually just match the sovereign spreads moments. Okay? And then in Schumann's papers, what he disciplines is using the secondary market's bid and ask spread. So the question is, can we have a little bit more direct measurement over this lender's demand curve or the elasticity of this inelastic lender demand? That's exactly how this paper, Matthias' paper with Sergio, they comes in. And they have this new empirical evidence using this exogenous actually supply change. They rely on this monthly rebalancing of this NBER Global Diversified Index. And then there are some passive investors. They just follow this index. And that generates exogenous supply change for the active lenders. Okay? And then they find out that the estimated demand elasticity is about 0.3%. And then they theoretically build this sovereign default model with a micro-funded inelastic lending demand. So they literally model these passive and active lenders as they see in the data. Okay? So the model is closely linked to the empirical evidence. And then they discipline their model with this empirically estimated demand elasticity. And then they quantitatively explore this impact of inelastic demand on sovereign debt and spreads. So the one key finding is that with this inelastic demand, the sovereign going to borrow less because they're going to internalize that if they borrow more, the interest rate going to be higher just because of this demand part. Okay? So that leads to a lower default risks. So overall, I think that the idea is very simple. Okay? We just want to know whether there's a downward sloping demand curve or not. Okay? But the task is very challenging because of the endogeneity issues. Okay, you don't know whether the price change is because there's change in demand curve or just because of the sovereign may default more or less. Okay? Overall, the paper has a very nice executions. Okay? So it's very smart and it's very beautiful. So I recommend everybody to read the paper. Okay? All right, so I think Matthias spent a lot of time in talking about the empirical part. I would just remind you a little bit of what's the key elements of the model. Okay? This is usually we see in the bond price schedule. So what they have is there's an actual lender demand curve. And the lender demand curve actually, this is they micro-funded with many lender models, many types of lender models. But the key part is that this is the demand, overall in this bracket, this is the demand of active lender. Okay? And this is a part of the elasticity. It is time varying because it depends on constant parameter kappa, but it also depends on this variance of the default risk of the sovereign bond. So that can be generates the empirical evidence, consistent with the empirical evidence that higher default risk would mean that there's a larger elasticity. Okay? So I want to say that you do see that is with the endogeneity issue, right? If there's a change in debt, there's a change in price. We don't know whether it's coming from the change in expected repayment or comes from the lender's demand curve. So what the paper has do is they deal with this endogeneity issue of using high frequency data. I want to say that's very cool. But on the other hand, it has one question, okay? Is really how much this elasticity matters for the sovereign government borrowings. When they issue the bonds, is this really the elasticity the government is facing, they are considering for the lender side? Okay? Because there are two potential issues. First one is the long run versus short run elasticity issue. The one we recovered is really the short run elasticity because it's coming from the high frequency data, right? But maybe that in the short run, lenders, the active lenders, they are liquidity constrained, or they don't have better information, okay? Or they're secondary market trading. The market liquidity has some issues, and so that's why they couldn't respond. Okay? But in the long run, they may be able to respond when the liquidity issue is being solved, or there could be new lenders coming in. So there's always the issue of the short run versus long run elasticity. I know the long run elasticity is very difficult to deal with in the data, but maybe we can deal with that in the model. Okay? The second one is in terms of the primary market versus secondary market prices or the elasticity. That might be different. Okay? You may have different types of lenders. Just to talk about that, I look at this data from 10-year Greek bonds. So the orange line is the secondary market price, and the dot is the auction price or the primary market price. Okay? And you do see that they follow each other pretty well. Okay? Except for in this case, there's probably about a 1% gap in early 2003. I asked ChatGPT what happens there. So this is also from ChatGPT, okay? But I want to say is overall it seems to follow each other pretty well. But of course, it could be also the case that even if we have similar prices, the elasticity might be different, okay? But again, I mean, this short-run, long-run elasticity or this difference between primary market and secondary market might be hard to deal with in the data, but we have a model, okay? And so what they could do is actually in the model, they could enrich their model a little bit, okay? So the one thing is they could actually incorporate the risk premium as well, okay? So there is a active lenders demand, there's a constant in their model. So they could actually make that, that constant depends on the country's output. That would just give it the risk premium. They could also make it depends on how much the country wants to borrow. That could potentially, if you play around with the functional form, could give you this long run versus short run elasticity, okay? I want to say this helps match the data better, and also it helps us to understand better what's the source of sovereign spread, especially during crisis time. Is it coming from the default risk premium, or the demand curve? Okay. So going back to my point of it help match the data better. Okay. I want to go back to this one figure and one table that Matthias actually showing us. So one thing he was emphasizing here is that the debt over output and output, that relationship, whether it's procyclical or not. So once we have this inelastic labor demand, you can see that the debt over output is not so responsive to output, okay? So it's not so correlated to that. But because of that, I think the model overshoots in terms of correlation between spreads and output. Okay? Because once you have bad output, if your debt doesn't change much, your schedule will move, and that generates negative correlation. So again, I think that seems like a higher, more negative than the data. And then if you're adding this risk-averse lender, and that's when the output is low, the risk premium is higher, that could help over fix the correlations. But of course, it could maybe a different calibration or any different shocks may be different. Okay. And my last point is about how important is this rebalancing shocks to drive the fluctuation of sovereign spreads. Again, this is actually, they can do something in the model, okay? All right, so this is my last slide. I think it is a very cool paper, and it's a very well executed paper. Okay, thank you.
Thank you, Yan. In the interest of time, let me collect a few questions if there are any. Okay, so let's start with a short response, perhaps, and wait for a couple of questions.
Okay,
Yes.
so first of all, thank you so much, Jan, for that amazing discussion. I agree obviously with all your points, so let me try to answer each of those. So regarding your very last point about the effects of these rebalancing shocks, we need to do more about that in the paper. We have some analysis showing that whenever there is an increase or decrease in the passive demand, then the government is going to react. What we show that the response of the government is always smaller to the regional shock. So for example, if the passive demand increases by 5%, the government only increases the supply of debt by 1%. And that implies that the inconvenience yield decreases and the price of the bond will increase. But I agree that we need to do more decompositions, especially unconditional moments, to try to explore what are the implications of changes in that passive demand. Then regarding the elasticity in the primary market, obviously we don't have access to that sort of data. There are a couple of papers that use auction data in order to estimate those elasticities. So there is a paper for Mexico by Cole and Ordóñez, and there is also a recent paper that uses data for Portugal that they estimate those elasticities using auction data. This paper that is for the Portuguese case, what they find is that the elasticity in the primary market is being driven by whatever is changing in the secondary market. So they do find this connection between the primary market and the secondary market. And then regarding your point that it is true, we are shooting a little bit this correlation between the spreads and the GDP of the economy. And as you pointed out, that is precisely because now we have a lower response in terms of debt whenever there is a shock to GDP. So in a sense, we're fixing one of the issues of these models in which the debt policy is very pro-cyclical. On the other hand, we have this issue in which now the spreads, they react a lot, or they're very correlated with changes in output precisely because the debt is not changing. So we can fix that by including some global shocks or changes in the discount factor of the lenders or changes in the market price of risk. So those are extensions that we can obviously include in the paper.
I have a question. So I think it would be interesting. So your comparative static on the model with inelastic demand versus baseline is very interesting and intuitive. But I think it would be also interesting to think about a recalibration type of exercise, just because, you know, that might allow you to say something about the inference that traditional sort of baseline models with risk neutral lenders have in terms of that overhang issues, volatilities of consumption, volatilities of spreads, etc., that are more, you know, comparable. So I think it would be interesting to think about, you know, that additional comparison.
Okay. No, yeah, for sure. That is something that we can do in a new calibration, matching also the level of the spreads under a perfectly elastic demand, and then compare other moments. Yes. Thank you.
Matthias, I have a question here.
Yes.
First, I think it's fantastic. I really like it. Something that would be nice would be, I think, to study a little bit more how good is this simplified setting of pricing and rebalancing for the particular market of bonds where dynamics of pricing and is a good predictor also, I guess, of defaults and stuff, I guess. I mean, not the same to think about any standard bond or stock that fluctuates and things go forever. So one where you see that the price dynamics are leading you towards a default. It would be nice to see how, with a simplified example or something, how this kind of works out.
Okay. No, yes, I think that's something that we can do for MPIC.
Cool.
Thank you.
Matthias? I have a
just one comment.
Oh, here.
Just wait. Okay, now it works. Just one little comment. Of course, the elasticity of demand is a very important element, and you did, I think, a great job in estimating that elasticity. I suppose that the data doesn't allow you to go for a very long period of time. But one element that would be interesting is that when you think about globalization, so the way we can think about globalization is actually that it increased the elasticity. So in other words, as the financial markets becomes more and more integrated, in some sense, the demand responds more to an increase in price. And I also thought that was interesting what Jan, the point of a short versus long elasticity. I think that she's right, that you are measuring the short elasticity.
Yes.
I was wondering, though, what are the implications? So when you think about the garment choice, is it more important the short or the long? And then it matters also what is the horizon of the garment. So time consistency versus.
No, I agree with your points. So measuring the long-term elasticity is challenging because of many reasons, as you can imagine. But we can use the model to try to use the model as a toolbox to see what happens if we start changing the long-run elasticity, make some counterfactuals, and then analyze the government response in different scenarios in which the long-run elasticity is higher or lower compared to the short-run, which is the one that we estimate. And that is something that we can actually do in the model, yes.
It could suggest that if the long-run is, the elasticity is higher, so that suggests that issuance of bonds should be smoothed.
Yes, yes, probably, yes.
Right. Any other questions?
So do you know in the data, can you see if there is some market segmentation? Because if traders specialize in, like, let's say, Ecuador, then there is inelasticity already there, because I don't know, I have some information bias and I don't want to move to trading Colombian bonds. So that's a different story.
Yes, I mean, going to the empirical analysis, these are all bonds that are part of the MB index. So by definition, the buyers, or at least the passive demand for those bonds is global in a sense, because they're trying to match the exact composition of that index, or they're replicating the weights across all the countries within the index. Now, for the active demand, it could be true that some of those guys, they're just specialized in the bonds of a particular country, so there is market segmentation, but that is exactly what the elasticity is speaking. So we're being agnostic on what are the sources of the elasticity, but it could be market segmentation. The fact that, you know, some guys, they just want to buy some bonds, not others. So whenever there is a change in the supply of that bonds, they're not going to be able to fully react to it, and we're going to observe a change in the price. So segmentation could be one of the reasons behind our inelasticity. There could be other potential explanation. Risk aversion could be one, or the fact that, you know, the traders or the intermediaries are constraining their ability to provide funds. So we're not going to be able to say much about the causes or the drivers of that elasticity, but at the end of the day, those are factors behind our estimates.
Okay, Sergio.
Well, thank you very much for all the comments, and thank you, Jan, for the great discussion. You summarized the paper very well and highlighted some issues that deserve more attention. One point that you raised, and also by Vincenzo mentioned, we use these estimates to do the high-frequency events because they give you good identification for many events. But the literature has identified also some big shocks that happen in these markets. For example, China's inclusion in the MSCI that can have effect within China across different type of firms, and spillover effects on other countries because of China's inclusion. We also did a paper with Thomas on Israel's rebalancing between the emerging markets into developed countries, and showed that these effects can have large aggregate effects even at the macro level, with capital flows on exchange rates. So I mean, there are some shocks that are more, they are persistent and can be huge in terms of generating passive demand, more sticky demand for these bonds that can generate these inelasticities. Thank you.
Okay, thank you very much for this great discussion. Let's do one more applause for everybody in the morning. We have lunch now, and we'll reconvene at 2. Restart at 2. I think lunch is maybe next. I'm not sure exactly where. Next door, perhaps. Yes.